Good morning, good morning, good morning, and welcome to everybody today at the Olympian Table. We'd like to welcome people that are viewing in.
Morning.
And first of all, as always, my good old friend, I'm going to word you old just to annoy him a little bit this morning, is James Lee from Lee Group Loans. Welcome, James. How you doing?
I'm doing well, sir. Doing well. Living the dream.
Absolutely. So we're here to sort of help educate everybody and see if we can help. And we're just going to add some comments to some different items and different questions that people have had this week. They've contacted us and they brought up some various points. Some of the agents at Olympian have called us up and asked for a bit more clarification. So that's the point of this Olympian Table this morning. And so we'd just like to go into some things in, greater depth. And we've found some videos that we feel are pretty applicable to it, correct, Jay?
Oh, yeah. Just some things to kind of share that help people understand. It's not just what we say as we sit here at the table, but it's what's going on out there in the world. So you'll hear different perspectives. We have a little video we're going to kind of do some commentary on, I guess, so to speak, to just kind of get an idea of, she's a real estate broker as well. Young lady here by the name of Nicole Nark. Just some common mistakes to avoid when buying your first home as a home buyer. So listen up and we'll kind of discuss.
Absolutely. Unless we'll obviously get your opinion, James, on that, then
Absolutely.
Perhaps I'll just tip in there a little bit, from a real estate point of view, just to sort of help things along.
Okay,
so
sounds
let's
good.
take it away.
Hit that real quick. So this couldn't be more accurate. When she was going through it, it's like people don't realize driving through neighborhoods. Oh, I see the pretty house. Oh, I see the pretty sign. Okay, that sign is there for that seller, and if you call that number, they'll answer your questions. They will even make you feel warm and fuzzy.
Yeah, and
let you in. But that they are not working for you as the buyer.
Absolutely. And the part to really focus on here, James, is people believe that they can contact the listing agent and they're going to save money, but they don't realize that that agent is representing the seller. The seller's agent is still going to get paid what it would be to have your own agent. So you're not saving no money. In fact, it's actually like exactly what Nicole said. That's actually costing you money.
It is. And in the industry, we call it, so if you go in and you happen to let this listing agent represent you, we call that a double dip.
It is a double dip.
Because it's both sides of that deal. And as much as it may feel like they want you to win, I mean, they're getting paid on both ends. It's like they don't lose either way. Now, I'm not saying that this is some type of illegal practice. I don't want someone to think that at all. But you do yourself a disjustice, an injustice, shall I say, if you contact someone on the sign and you don't have representation yourself.
Right.
Period.
And I think there's less motivation for the listing agent to negotiate you a better deal because they're getting both sides of the deal. It's a smoother transaction. And in Texas, the part that's really important for people to understand is, from a real estate agent point of view, is if you're in what they call an intermediary situation where you're representing the buyer and the seller, you can't give advice to either party. All you are is basically a messenger taking what you want to offer to the seller, and yet that agent, as you said, is double dipping and getting twice the amount of money that they normally would. So where's the motivation in that for them to drive a better deal? We have a part of our training in the office is what we do is we tell the agents that for you to get your commission secondary to the client's interest. But two, part of your job is to get the best deal that you can do for your client by negotiate all the way through the transaction. At the offer point, through the inspections, through the appraisal, if it's needed, if you get the opportunity. Sometimes we've even done it before, even at the closing table when you do the walkthrough.
Absolutely. So that's
a very, very good. This is a very, very good point.
It is.
And the biggest mistake I think that a lot of people make.
Absolutely.
There you go.
Exactly.
Hallelujah, Nicole.
Oh, okay.
Hi everyone, my name is Nicole Nark and welcome back to my channel where it is my goal to help you find your way home. The buying process lends itself to so many easy missteps, and if you're not careful, making these mistakes can make you lose thousands of dollars. Luckily for you, in this video, I am going to share the 8 biggest first-time home buyer mistakes so that you can avoid them. And make sure to stay tuned to the end of the video where I share the gut-wrenching one that I made as a first-time home buyer and how it cost me $5,000 right after moving into my home. So let's get right into them. Mistake number 1, contacting the listing agent. Now, when you're looking at homes, you may find yourself calling the phone number listed on a real estate sign, or contacting the agent on a listing for Zillow. If you do those things, you are contacting the listing agent, and the listing agent is the realtor that is hired by the sellers to sell their home. Why that is important is because that listing agent represents the seller and their needs. The problem with you contacting them is that this agent is not looking out for your best interests at all. They're trying to get the best deal for their seller.
So if we had to add something to that, I would say the listing agent, and one little caveat that I don't know if she'll cover it or not, this is also the case. Many people walk into builder communities,
big time,
and they feel like the builder, oh, it's the warm and fuzzy, they love me, they pat my kid on the head. The builders are essentially, they're the sellers of the property. And that sales counselor is coached and trained to make you feel at home. That's why they have the office in a model home, so you can feel like you're already there. So those people are not working on your behalf. They are working on the behalf of the seller of that property.
Absolutely. And this really is the biggest mistake and the biggest frustration that people have. For the reasons that, you know, with Trek, it's called intermediary. And basically what happens if you're in an intermediary situation, that if there's one agent who's the listing agent, represents the buyer, they can't give the buyer advice on how to get a better deal and a better price to negotiate, because then they become a message taker. So they can't give advice to either party, but they've already given a certain amount of advice to the listing, you know, to the seller itself.
Sure.
So at Olympian, we actually teach our agents to negotiate 4 times. 1, before you execute the contract, 2, during the inspection period, 3, if possible, at appraisal, And 4, we've even negotiated at the closing table
It can happen.
when we've done the walkthrough.
It can
You know,
happen.
to get that better price.
Right.
That time the seller just wants to get the deal done. And so it's very frustrating at times when people think they can get a bigger deal. And the other misconception is that some people think, well, if I contact the listing agent, then I can get a better deal with them because they'll reduce their commission. I'm going to get a better deal. But the truth of the matter is, the listing agent's actually going to get paid twice as much for doing half the amount of work. If you've got your own agent that's going to work for the buyer, they're negotiating more. They're giving it more of a punch.
Absolutely.
I mean, they really are negotiating more because if they don't, and they don't get the deal done, they're not going to get paid because they haven't earned their commission.
Right, exactly. It's much like going into court without a lawyer. I mean, you can do it, but it'd be a lot better for you if you have some representation on your behalf.
Absolutely. And in Texas here, the Texas Real Estate Commission, which is the body that overlooks real estate agents, I personally feel they could have a better input and do a much better job. But what I will say, the Texas Real Estate Commission actually advise people not to get into an intermediary situation, but to get representation. There's a form called Information and Brokerage Services that a good agent is going to give you when you first meet them.
Makes sense. Okay, shoot. Let's see what else she has to say. I know she has some good stuff on here.
It's to find your own buyer's agent. Mistake number 2, running up a credit card balance. As a first-time home buyer, you may not know this, but your credit score can actually be checked multiple times throughout the transaction. I repeat.
I know you're going to like this because we speak about this all the time, James.
Not can be checked. It will be. It will definitely happen. Now, this wasn't a practice back in the day before the credit crisis, but now we pull the credit, and it usually lasts 3 to 4 months as far as the credit report. But at the end, once we're ready to go ahead and go to closing, there is something done to refresh. We want to see what your new balances are. If you've added any new debt, we will pull the credit. Again, it's not going to show up as a hard hit, but we will take a peek to see. And I can't tell you how many times this has happened.
We've spoke about this a lot, haven't we, James? The amount of times where they're buying a house and then 5 days before closing, what do? They go out there and buy bed furniture. They go out there, refrigerator.
Yeah.
A good agent will tell you, do not go out there before you close the property and buy your new bedroom furniture because it will bust out your deal.
And it's like, oh, but it's a Memorial Day sale. It's like, man, that stuff will be on sale again later. Just wait. Just wait for it. It's not worth you lose. You can get your sofa or you can get your house. Which one do you want to pick?
Patience is a virtue when you're buying a house.
There you go. There you go. Right on, Nicole. Let's see what else you got.
Your credit score can be checked multiple times throughout the transaction, not just when you are filling out your pre-approval. So what's a problem with running up a credit card balance? The higher your credit card balance goes, the more that is going to affect your debt payments, and that goes into calculating your DTI. And your debt to income ratio, or DTI, is a very important metric that lenders look at to determine your loan eligibility. So if you haven't already, make sure to click and watch my debt to income ratio video where I explain how to calculate this on your own, because if yours is too high, that can be detrimental to your home buying process, even if you are already under contract. So what's the solution here? The solution is don't go and buy a bunch of appliances and brand new furniture for your house on a credit card until you have closed on the house. A really great way to scare the crap out of your agent and your lender, if you're good friends with them, is call them up or send them a text and tell them that you just went and bought a new car.
I want to
probably call you immediately. Or if your agent...
I want to comment on that. I've always believed for a real estate agent, never work with friends or family. I always suggest you select somebody who is proficient at the job, experienced, and can do the right thing to you. in the long run, it'll save you thousands of dollars. And I really think a good agent, that and this is one of the things that a good agent will do before they close is say, even a good loan officer, correct,
Sure.
will go out there and say, do not go out there and buy your appliances and your bedroom furniture
Absolutely.
before you close on the house.
I actually have a list of do's and don'ts. And really, quite frankly, it's mainly don'ts. That just lets people know what not to do if you want the keys at the end. Don't do this. Don't do this. Don't do. It's a list of, and I send it out as an email, so they have it in front of them and they're aware of things to kind of stay away from. And that's one of them. Running up your credit card balances.
It's a fabulous point.
Yeah.
Another good point.
Is not giving you a call back, just send them that text. I guarantee you they'll call you in 5 seconds. All right, guys, if you are learning something from this video, please give it a thumbs up. And if you haven't already, subscribe to my channel
Give her a thumbs
so
up.
you can join our
Okay.
community and find your way home. Mistake number 3, sharing your full pre-approval amount.
Okay, put a pin
Now,
in that.
when you get
So she's talking about sharing that with the seller.
Right.
Now, what's your thought on that? Because I've had people know that it doesn't matter. They submit the offer and they put in the amount. But some folks, think it's a big deal. What's your
I
thought?
think from a strategy point of view, from an agent point of view, especially with the market that we're in, I think it could work for you and it could work against you.
Okay.
I don't think there's a necessary plus or a minus because with the multiple offer situation we're in at the moment, it could be a benefit. But at the same time, I think you've got to ask yourself, are you overpaying for the house?
Right.
So my personal feeling is a good agent will give you strategy and negotiate any offer. So from that point, I really think it depends on the situation. I'm not avoiding the question, but I just think from a strategy point of view, you've got to ask yourself how much you'd like the house.
Mm-hmm.
And it's a little bit like, I call it real estate poker. A little bit like holding your cards to your chest,
Sure.
and I'm not showing you what them cards are. So I think it's nice to have a little bit of gas in the tank. But the truth of the matter is, it really depends on how much the client likes the property. Because if they know that you've got more available, is that a strategy? Because a good listing agent's going to be using strategy as well.
Of course.
Is thinking, well, perhaps I can get that up a little bit. Perhaps I can get a little bit more for that. Perhaps I can get the buyer to put a bit more cash down on the property. Because we spoke about it the other week. Some people are thinking that FHA loan isn't as good as a conventional loan.
Right.
They're putting more money down, but that's not true. It's just not true.
No, I totally agree with you, and I think that the kind of being in the middle of the road, I that's kind of where I am with it as well. Where some are kind of really hard sticklers. Well, if I'm going to offer 210, I need a letter for 2. If I'm going to offer 220, I need a letter for 220. And it's just like it's a pain for us to have to generate a letter every single time to match that. So I'm like, if you're negotiating, maybe you put that offer in and you get all the details, get them on the phone and talk to whoever. You kind of almost get kind of a verbal confirmation, and then you send the letter.
The downside to what you've just said is if it's taking extra time, are more people actually making an offer on the house? You're better off getting the offer in
there. Yeah, no, I agree.
Getting the offer in, and then the other agent's got a bit more time to think about the offer. So
Yeah.
I don't think it makes that much, but there again, it's down to the individual situation.
It was the phrase, you think long, you think wrong. So you might miss out on it. So.
approved, you are going to want to run all around town and tell everybody that you know that you are getting ready to buy a house. But you want to make sure not to tell everyone how much you are getting pre-approved for. If the listing agent we talked about knows how much you are pre-approved for, then you've completely lost all negotiation power. If you make me an offer of $200,000 for my house, which I have listed for $200,000, but you give me a pre-approval letter for $215,000, then I'm probably going to ask more of you because I know you can afford it, and I'm definitely not going to let you try to negotiate me on the price.
Nicole's a hard
So the
one.
solution to this misstep is to be careful who you tell about your pre-approval amount. And a great tip here is when you are making offers on a property and you submit a pre-approval letter to go along with that offer, make sure that your lender is giving you a pre-approval letter that matches the offer price that you are making. That way, the seller or the listing agent doesn't think that you can afford a penny more than what you are putting on the table. Number 4, mistaking closing costs for being the same as a down payment.
Oh
Everyone
my goodness,
talks about
this
down
one
payment,
here.
but
This one's getting
nobody's
deep,
really
Jay.
talking
Hey,
about
man, you know
closing
what,
costs.
Nicole?
Problem.
She's hitting some good ones. This. Oh man. Okay, so we know that there's the financial pieces of the transaction. To start, we got earnest money, option fee. Then you have inspections that you have to pay for, right? The down payment is just that, a down payment. There are costs associated with closing the transaction. And many times people, they blur those lines and they think that, oh, well, my down payment is just my down payment. So if you say 3.5%, that's all they're calculating 3.5% of whatever the price is, and that's it. And they forget about the closing costs. I can't tell you how many times I've had to break someone's heart to say, oh no, I'm sorry, there's an additional $6,000 you're gonna need, because on the sheet, it's listing everything as closing costs. But there's prepaids in there, there's the escrows, there's title fees, everything is called the closing costs, but it's all associated with the loan. And many times folks miss it.
Yeah, and the agents that we've trained, especially some of the new agents, they come in and they say, well, how much are the closing costs? How much should I ask for the closing costs on a transaction? Because they're making an offer for the first time.
Right.
But the truth of the matter is, they're not going to know. They can get a ballpark figure.
Sure.
But the truth of the matter is, they don't know if it's in a HOA that changes it. The loan origination fees, perhaps a little bit different with some of the lenders.
Absolutely.
Perhaps they pay for points,
Right.
to get the rate down. Been there, done that, which was, at the time was a mistake.
Stop beating yourself up about that, man.
But, well,
But it's
a
true.
good loan officer told me not to, and I went in and says, no, I'll just go do it. And then basically there's a lot to it. There's a lot of, and everybody's credit is different.
Right.
So you can only give a range, and agents really, I feel, make the mistake by getting involved in that, because once they've committed to it, they need to basically, I think, always refer them to the loan officer.
Absolutely. That's safest. Even if I can answer pretty much any real estate question that comes my way, but I don't hold a real estate license. So I don't step into that realm. I'll say, hey, you know what? You need to talk to your realtor about that, or your realtor will help you with that, because it's always safest. Many times I think agents, and not to beat up on them, but it's usually a newer agent because they feel like they need to know everything. And they'll go ahead and stick their foot in their mouth sometimes and offer information or advice about something that involves the numbers, and it can get them in a bit of a pickle. But this part, this down payment and closing costs, make sure it is a big issue.
And there's nothing more embarrassing for the buyer and the agent 3 days before closing to get that closing statement.
Oh yeah.
And then there's another $3,000 or $5,000 that is missing from the table to get the deal done. And you've all worked so hard,
right?
And then it's a simple case of losing your earnest money.
Do you go for it? Do you borrow that money from dad or mom?
Right. And the other part that I just want to add to this, that's why I think it's so important to get an experienced agent, knows the market, knows the area, so they know what to negotiate and how to negotiate and even when to negotiate it. And at the same time, have a lender that you know and trust so you can work as a team. A big mistake that people make is they might go to Bank of America, Chase, or Wells Fargo, and there's that level of communication that's missing.
And you don't have as much control. I mean, being away from one of the larger institutions, you gain a little more control as a loan officer,
Right.
Where we can actually kind of, if I gotta give some a little bit of a credit to help out, I have a little bit.
And
more
I just want to push out as well
right?
that they're good organisations.
Oh yeah, absolutely.
But the truth of the matter is, it's that communication that's lacking.
They do things different,
and sometimes it takes a little bit longer to get the answer that you need.
Sure.
And when you're in that time crunch and you're making an offer or you're negotiating and you're doing that you need a direct answer.
Absolutely.
So if you're working with a partner that you trust and know does a very good job, go to James D. Loans, the Lee Group. But basically, that way, I think it's important that you have that relationship, put the buyer in a stronger position.
I agree. Let's see what Miss Nicole has on this down payment and closing costs.
Is not knowing about these and not preparing for them. Now, the solution is you can definitely be educated on what those closing costs will be ahead of time, so that you know how much you actually are going to be bringing to the closing table to buy your house. Additionally, a pro tip here is work with your agent to see if you can negotiate some closing costs into your purchase of the house. Just to give you a ballpark, these closing costs can be an additional 3% of your purchase price. So if you're putting 3.5% down, we're at like 6.5% now. If you're interested in learning more about closing costs, click up here and I have made a
video
full
for everything,
video walking through what you can expect. Mistake number 5, not getting adequate home insurance. So the solution to this misstep is I always recommend that, especially as a first-time home buyer, you apply to get multiple different insurance quotes. This is great to do with your current insurance company for your car, or your lender and your agent can also put you into contact with great representatives. So at least get probably 3 different insurance quotes. Now, what you want to look for is actual cash value versus total replacement cost. Now, while an actual cash value policy may be cheaper when it's broke down into monthly payments, for that policy, you are actually paying for a depreciated version of your house.
Let's see.
So let's say you buy a house from
basically, what she's saying is, which we require, that you need to get replacement cost insurance. So, and I'm sure the example she's going to go into just talks about this. You want to have insurance that's going to basically cover you if your house were to burn down to the ground. You have to totally replace it. If you go with a cash value policy, it's basically going to give you a certain amount of cash, and
it may not be enough.
It may not be enough. We know with the price of lumber and everything going up right now, it may not be enough. And I think that's what folks are dealing with that have had these types of policies now, that they need to go basically kind of cash in. There's not enough money in the policy for them to build the house at the cost that it is to build it today. But if you get a replacement cost policy, it's going to replace it. It's going to make you whole, and you can move on down the line with it. So most lenders will require that, but again, it's truly up to the customer to pick what they want and what insurance. And most folks go for cheap, and that's not always best.
We have an insurance company, within the company, Olympian Insurance, and some people contact us when we've got the closings, and we encourage them to get a bid. If you've been with some of the big insurance companies, the Allstates and different companies, go with them, but the rates change every year.
Right.
We encourage them, get 2 or 3 bids. Get 2 or 3 bids on the insurance.
Absolutely.
And you'd be surprised, the repaired value and even the quotes, they differ. Some of the companies, if you've been with a company for maybe 5 years, 6 years, it's surprising at times the difference that you can get. And so you can get the better policies at a cheaper price, just a little bit more work, shipping around, and shopping everybody.
Right.
And shopping the various companies.
Okay. Let's see what she says about
it. 50s. And God forbid something happens and you need to make a claim for your whole house that got destroyed. Your insurance company is going to depreciate that home and basically take its value but make it 70 years old. And they are going to give you the money for a 70-year-old house, and nobody wants that. So with a total replacement cost policy, you're going to be actually given the amount, if God forbid anything happens, to rebuild your home as it stands. That's a big differentiator between some home insurance policies that even experienced home buyers often overlook. So make sure that you are getting a fairly priced insurance policy, but one that does give you the coverage that you need. And always reach out to insurance providers. A lot of them understand that insurance verbiage is tricky and that you will likely have questions, and they're happy to help.
Can I just add one point?
Mistake 6, overlook.
I just want to add one point to the insurance question, and that is, on the Gulf Coast in particular, we have additional insurances that come into play. One is windstorm, and the other is flood.
Good point.
And that is also, and it sort of overlaps with closing costs, so that pushes some of your closing costs up.
It does.
And in some area, I mean, if you're lucky enough where the previous owner has got flood insurance, the beauty of flood insurance, many times it's pegged at that amount.
Right.
But sometimes if the previous owner and the owner that you're buying the home from hasn't got flood insurance, then it's a new policy, it could be a completely much higher rate.
Totally.
But in the, if you're on the Gulf Coast like we are, that could be a big deal.
That's a good point. It is, because we're in considered windstorm areas, and where hurricanes are common, and you got to have that.
They're getting more common.
Yeah, you got to have that extra layer of protection. So, mistake number 6.
Looking first-time home buyer programs. If you make the mistake of overlooking these programs and not even trying to apply, you could be losing out on free money towards your down payment.
Stop it right there.
Easily
I knew she was going to say it. So this money is not free. I hate when I hear people say that. I'm not knocking anyone using first-time homebuyer programs or down payment assistance programs, is basically what they are, if they need it. Where we live now is people are getting them because they have this mindset, hey, you don't miss out on it. You just need to go and apply for it. Well, it's not that simple, because there are fees associated with taking this money. The interest rates are higher for taking this money. So overall, it could end up being a good thing as far as you not having to put as much money down, but is it the right product for you? In the long term, if you're comparing apples to apples, it may not necessarily be the best. So I think people should approach this with caution and talk to the loan officer. People all the time come to me asking about first-time homebuyer programs, and really what they're meaning is they just need some money for down payment assistance. And many times I'll say, well, there are programs that are available. You have excellent credit. Do you have a 401k? Oh yeah, I got a 401k. Well, how much you got in it? Oh, about $50,000. Well, let's use your 401k, and I can get you a much lower rate than what you're going to get with this program, and then you be in a much better position in the long run with this particular loan by using your own money to do it. But there are some folks that don't have 401k or they don't have savings, and there's nothing.
But do you not think it's the same scenario as somebody saying, well, I want to save up my 401k, but I'm putting money into my 401k, but I've got overextended credit on my credit card, so they're paying all this interest. So really, they're not gaining anything.
This is true.
So as a comparison, that really is because you and me have seen in the past where some people might have chosen to do a down payment assistance and the rate is higher, and over 30 years, that's a long time.
It is. It definitely is.
Because the interest rate is higher, but they expect that they can get a down payment plus the low interest rates which are available.
Right. And a lot of people that come in that are buying homes right now, they're very rate sensitive. Most of the people that are buying homes right now have never seen interest rates over 5%. So if you tell them, oh, it's going to be 4% or 4.25%, they're like, why is it so high? I say, well, they're giving you $10,000. I mean, they got to make money somewhere. They're going to do that. So I want anyone who's watching or anyone that share this video with, you need to be aware that the money's not free. there's a cost with it. And depending on the program, there may even be a time frame where you have to stay in the house for a certain amount of time, because there's a plethora of different programs that are out there.
Right.
I would suggest talk to your lender, and if it's a matter that you need money, see if that, because there's some certain ones that I like to be able to give to people that don't have as many restrictions on them, and then
Right.
they can get them, and they're not stuck in the house for a certain amount of time, and try to keep the fees kind of low. So it's always key.
And as a new first-time home buyer, I think it's important that you keep your costs as low as you can on a monthly basis. Basically, because there's costs out there that always come up with maintaining a house.
Absolutely.
And things that might happen to the house that you might have to get fixed. I really think in the long term, you really are better off seeing if you could get a better price over the term.
Right. I agree.
And then in the long term, perhaps you've got more money to put into your 401k because your monthly expenses.
Are
Because it's all
lower,
about
right?
cash flow as
Oh,
well.
yeah,
It's important.
for sure. Let's see what she says about this thing.
For. So the solution here is to look up the down payment assistance program in your area. The information can't hurt to know, and I would love for you to be able to keep extra money in your pocket. If you want to know more about down payment assistance programs, I've actually made a separate video specifically that talks through the different kinds, and it also has a link to where you can find the ones in your area. So I will link that above now. Mistake number 7 is not keeping enough money in the bank account for an
Now look at the
emergency
irony
fund.
with this, right?
If you do not
So
have a
on
little
number
bit
6, you're talking about asking for free money, and now you're beating me up about not having an emergency fund.
What did
Come on.
we just say? What did we just say?
They most folks that they don't have it, and they don't have it. And you got your 401k.
Well, what do they say? The average emergency fund with an American is $600.
Yes, exactly. Most folks don't have a couple months of expenses kind of put away.
That doesn't even cover the mortgage.
And it doesn't. And quite frankly, I think that's just a key of life. You should have some type of emergency fund, period, whether you're buying a house or not. But where we are today, I can't tell you, Steve, how many times I get a bank statement, $50 in it, or get a bank statement with, NSFs in it. People just feel like, oh yeah, I'm just going to go and buy a house and I don't need a whole lot of money. Well, you may get in a position where you don't need a lot of money, but you still need to have an emergency fund, because once you close, that house is yours.
Right.
There's no more picking up the landlord and coming and say, hey, my sink is stopped up, or the toilet is overflowing, or whatever the case is. It's on you.
Right.
You're the homeowner. You got to take care of it. So what are you talking about, Nicole? What is she saying?
Well, as I said,
extra money that you set aside in the bank for any repairs that you may need to do on your house, you could run into a problem if anything popped up. So a great solution to this is whenever you do find out how much your mortgage payment is going to be each month, maybe round that up to the extra 100 and put that extra money into a bank account. That way, that little bit extra is saving on the side so that if anything popped up, you are not too stressed about covering that plumbing bill or the electrical bill. If nothing does pop up, then treat yourself to some new throw pillows at the end of the year. Mistake number 8, and the nearest, dearest to my heart,
What is she gonna
not
say?
checking the utilities before buying the house. If you don't look at the utilities on a house before buying it, you don't know, first and foremost, how much to budget for when you actually close on the house. And you may also fall into what I did. Right when I closed on my house, when I did not look at any of the utility bills, I started up my water with the water company, and all of a sudden I received this lovely bill in the mail with like an $800 water bill. And I was blown out of my mind. Not only did I not have the emergency fund that I talked about, so I didn't have that kind of money to pay the water bill, but I had no idea if that's how much water bills even cost or if that was out of the ordinary. So after long phone calls with the water company, it turns out that the water line to my house
had a leak
that goes from the house to the street had basically ruptured. And if you don't know, any of those lines that connect to your house and from the street to the house, gas lines, water lines, any line that connects from the street to your house is your responsibility to take care of. I had no idea.
So this water line is interesting. I don't know where Nicole lives, but you can pull the utility history here in Texas as well to find out what the average bill has been on that house. That's actually not a bad idea. And it's not one that I even offer to people on a regular basis, but I've done that. I did that with my house. But you don't think about it. That's just one of those things that you can tell people, hey, make sure you want to check let's say, for instance, if you're buying a house with a pool, you may want to have an idea as to, okay, how much are they paying extra because they have these pool pumps running all the time. Right. So you want to kind of get an idea. So that's an excellent tip to add there.
I believe so. It is.
Excellent tip to add there.
Which probably was causing the last owner problems. Cost me $5,000 as soon as I moved into my new home. Needless to say, I was not a happy first-time home buyer for very long. So the takeaway here is that it's great to request the utilities from the current owner before you buy the house. That way you can look at them, you know how much to budget for monthly, and you know ahead of time what those average numbers are so that you know if anything spikes and is out of the ordinary, you may have yourself a problem. That wraps it up. Those are the biggest mistakes.
There's one point I want to add to this. A lot of utility companies offer insurance, though.
For those lines?
For those lines.
You know, they've started doing that more often.
Centerpoint offers that at the moment, who's our local gas company. They offer it. The water company offers it as well. They offer an insurance for a relatively good amount per month.
Yeah, I've been clicking off of that offer every time I get in. Might need to get in there.
Perhaps you might rethink it.
I might want to get in there for sure.
But I just want to say, that I really like what Nicole says. I think this is an excellent video.
Oh yeah, definitely. I think it was good information when I found her. She's a real estate broker by trade, like you. But I can't remember what state she lives in. But nevertheless, she gives. Oh, is she? Arkansas. Okay. Yeah. Oh, wait. Arizona, California, Georgia, Oregon, Florida, Texas, and Arkansas. Yeah. So she's got some presence out there, and she's very versed in what she's doing. I watched several videos, and a lot of the stuff that she says is spot on, with the exception of calling it free money for that down payment assistance, because it is not free. But good stuff, though. Definitely good stuff. Is there anything else that you think that you would add to the list of mistakes people make, or things that they, should kind of look out for? Or that they even think, some myths, I guess, so to speak.
I think the biggest myth that people do is, we've really addressed it, is the down payment assistance program. And like you said, a lot of people have got this conception about the interest rates. It's the lowest it's been for a long time.
Right.
When I bought my first house, it was 15.
Oh man, that was
95.
That was where they were. They had come down from there.
So it will go back up. The unfortunate thing that I do feel is, on the first time home buyer side, I do think perhaps we need a better system to get people onto the ladder. We've mentioned the Biden program with the grant, and we've had some people call in saying they want us to discuss that in more detail. But the truth of the matter is, I feel it's the difficult thing to do when you haven't got the inventory at the moment.
It is, but I think we have to do a good job at putting out information like this, so that when it does normalize, people are educated and they can make a decision based on the facts that, hey, I've got enough money for a down payment, or I need to look out for this, or I need to look out for that. I think we get in trouble when we flood the market with uneducated, uninformed consumers because they just run amok with everything. That's why you got people in grocery stores running, buying all the toilet paper and water and hand sanitizer because they just feel like we got this kind of this hoard mentality. And we have to make sure that us as professionals are doing a good job with informing people, putting the information out there so they kind of know
and there is
where we are.
One more point that I just want to point out, which is from a point of view that Nicole addressed for the very first point, which was contacting the listing agent. Mm-hmm. If a contract's been signed and you're working with the listing agent, you're actually in the negotiating point at times. There's a lot of times when people have actually contacted us and they've said, well, the other agent, I don't feel he's doing a good job for me. But at that point, the way the industry works is we can't comment from a professional standpoint on somebody else's work.
Right.
So it gets very difficult, a very, very fine line on what we can say and what we can't say, because at that point, they're in a contract with somebody.
Sure.
If they've signed the correct paperwork, very, very difficult for another agent to comment. If another agent is professional about what they do, then basically they're not going to comment on it. And it's very, very frustrating for us as a caring individual, for somebody that wants to, get a fair deal. And we've seen some deals. There was somebody called the other day that the lot was worth $46,000 and they'd signed a contract for $57,000.
Oh, wow.
And the other agent had done the contract. That's just for a lot.
Wow. So they're going to play. Well, I will say this. I think I got a couple of things that I would add to the list as far as myths or things that people believe. Some people think you got to put 20% down to get a home. And of course you don't have to do that. I've even had some agents call and talk to me and ask me about the need to put 20% down. That used to be a thing before, we got the advent of mortgage insurance companies, which protect the lender for any loan default. But you don't have to put 20% down. You can get in as little as 3% down. And there's special programs that might give you zero down at particular lenders, and then of course you got USDA and VA. But 20% is not required on a mortgage, and we want to make sure that folks know that you don't have to have 20%. If you have it, that's great, but you don't have to use 20% to get into a home. Yeah, as little as 3% down. Yeah, that's key. I think another thing I would say, people think you gotta have perfect credit too, and you don't. You don't have to have perfect credit. I closed on one yesterday. Family, actually I've closed, there was 3 this week, but the first one this week, they were not credit worthy when they came to me. And I told them to do some things. They did them, and we closed this week. And it was probably 4 months ago when we first started.
Right.
So it didn't take that long to do, but credit wasn't perfect, and we got them into a mortgage. The one yesterday, the same situation. They actually got denied with another lender. Came to me, I told them what we needed to do, moved through the process, and we got them closed.
Right.
So you don't have to have perfect credit with it, but you do have to have perfect patience, because it's not going to be overnight. It'll take longer. I think sometimes people get into that frantic microwave mentality where they want it yesterday. Right. And it takes some time if you're truly serious.
I think a good agent, though, in all fairness, will ask people, even when you're going out and showing a rental, and they'll say, well, why aren't you buying? The reason why you're not buying, right. Is it your credit? Do your circumstances
Absolutely.
Not fit you?
Absolutely.
Because sometimes we've been in positions where people go out to rent, as they release their situation and give us more information, we're like, well, we've got a program where you can get into a house. Would you rather buy a house or would you rather rent a house?
Right.
Sometimes they've come over, and plus, we have a credit repair program where we basically can rebate that money back to them.
Absolutely.
So at times we've done that, and that's more gratifying than anybody else.
It is.
Any situation.
It is.
There's somebody that went out there with an exception, and you've exceeded expectations with the patience that you said, a little bit of experience, a little bit of knowledge. We've helped them buy a home.
And those people are the most loyal, and they'll be your loudest cheerleaders, the ones that you actually help and they listen. Because I have gotten a referral from one particular family over and over and over again from them because they came to me and they weren't credit ready. And they, time and time again, as they did what I asked them to do, we closed, they were happy, and they've sent me their kids, they've sent me friends and coworkers. I mean, everybody. And they always speak my praises, and I appreciate that for sure.
And then they have a much better life with that. They're in
Yes.
a house, their credit is better.
Absolutely.
But it takes dedication to work on that credit, and it
Absolutely.
takes discipline. As an Olympian, it's the discipline and the focus that's important.
Right.
You don't focus on them goals. Your goals.
I totally agree.
But one of the things that I do want to bring up, James, and I hope you don't mind me bringing this up, is, when do you buy a home? When is the right time to buy a home?
Shoot, man. Now I say do it now. Now is the time, but you want to do it when you know where your credit profile is. When you are able to have some money saved for down payment and closing costs. Where we live right now, it's one of those, if you wait, you literally could be paying $20,000 to $30,000 more for the same house in less than a year. So it's a unique kind of market because it's not kind of a bubble kind of deal, like it's going to burst some way. But it's just the demand is so high versus our supply that it's driving up the price on everything. So I think it's key to get in now. Get in now, get your credit. Make sure you know what your credit is, of course. And if it's not great, let's work on it. Let's get it together. And then get in line. Start working on getting prepared mentally to buy now.
Get a bit of focus and discipline.
Yeah, absolutely.
That's really what it is.
Absolutely.
And how do you envisage interest rates to go up?
So they'll go up. I don't think they're gonna go to like double digits and anything like that. We don't have to worry about because that would totally stagnate the market. But they'll go up. They'll come down. I have a small hunch, honestly, just me being wishful, maybe that they may even go lower than what they were before. Several months back last year. That's me being hopeful. I just feel like now. They'll probably stay about where they are, kind of hover a little bit, and maybe eke up a little because it's such a demand on homes. So if you shoot them up too much, then that demand, it's going to kill all of that demand and that momentum. And then you have the exact opposite of what we have now, a surplus of properties, and that can affect values and such.
Right. Then the next point I want to bring up is, your point of view of renting versus buying. What's your feeling on that renting? Because we've just spoke about it. Like I said, we take some people out where they're looking at leasing a property for $2,300 a month, $2,700 a month. We had one the other day that's leasing a property for $3,500 a month.
So you're going to have your 6 one way, half a dozen the other on this argument, right? As a matter of fact, I saw a Facebook post the other day where someone mentioned that, I'd rather rent, blah, blah, blah. Renting something, you never own it. There is no value going to you personally. You're literally paying someone else's mortgage. As an owner, you try to buy on your own. It's an appreciating asset. As soon as you buy it, that thing is not like a car. It's actually an asset that will appreciate just naturally. So, of course, taking your money and putting it in something that's going to appreciate sounds much better than renting it. But on the flip side of that, you have some people that are in short-term situations where, let's say it might be for a job, and I'm only going to be here for 24 months. And I really don't like the city. So why would I buy something here if I'm only going to be here for a short amount of time and I can move off and leave in the drop of a hat because my lease is over? Now, my argument to that would be you could buy it and then you could lease it to someone else.
Right.
Buy that house, right? And of course, they'll be paying your mortgage, but you still have that asset. So if anything were to happen, something falls through and you have to move back into it, you got a property or somewhere to stay, because it's getting tight with leases as well.
Well, there's 2 points I want to add to that. Is the first thing is one of Robert Kiyosaki's prime points is you can make money. The people that make money always use other people's money.
Right.
So you've got that point. So basically, when you get qualified and you buy your own house, then you're using somebody else's money. But the other point that I want to bring up, which I think a lot of people overlook, is if you buy a house, your fixed cost of the mortgage is fixed for the next 30 years. If you're a good landlord, then you're increasing that rent between 3 and 5% per year. So your rent is actually going to go up continually over time.
Right.
So you look at it that time, you've got to look at it over 30 years.
Right.
So the point of the matter is,
stay the same.
You've got to look at it. If you want a fixed cost for the next 30 years, then you really are better off getting that mortgage.
Right.
Plus, it's a double-edged sword when you start looking at buying real estate. Is the cost of that asset is going to go up for the next 30 years.
Right.
So as your mortgage goes down and your property goes up, what you're actually doing is you're getting equity in the property. Now, agreed, you've got your costs that are coming from that, which you could have to repair stuff that Nicole brought up. The truth of the matter is, I do feel that if you've got a rent, that rent is going to go up over the time.
That is true. And that's a benefit, because you pay a mortgage, the mortgage is going to stay the same.
Yeah. So what I always say to people is, well, do you want a fixed cost over the next 30 years?
Or you want fluctuating?
Or do you want it to go up gradually over time?
That's true.
So that's my biggest point with always rent to buy, is people should look at that more. And so back to my point in a way, what if someone is renting for $200 a month? Why should
not just get a mortgage, right?
Yeah, absolutely.
Yeah.
I mean, that's
$2,300 that'll buy you a pretty nice house.
Right. Absolutely.
Yeah. Definitely buy you a pretty nice house.
And so we've also spoken about, that's one of the benefits to me by buying a house rather than renting. You've still got to pay your utilities.
Right.
You've still got to pay your gas.
Absolutely.
Still got to pay the electric.
Absolutely. That didn't go away.
So, and now let's go back to the finer points of getting a loan. I mean, what are the things that a buyer getting the documents together? You've mentioned the credit score, and then how do they get that together? What do they get their wage? What do they do? Their wage documents together?
Yeah. So just real quick in a nutshell, you'll need to get paychecks to cover 30 days. So typically, if someone's biweekly, that's 2 paychecks. You'll need bank statements to cover 60 days. That's typically 2 bank statements. You'll need W-2s to cover 2 years. And then photo ID, social security card, and tax returns is usually what I would ask for as well to cover 2 years. So you're getting the most recent 2 years of documentation to show that you can actually prove that 2-year history. And not that you have to be on a job for 2 years, but we have to have the documentation to show that you've been working, the past.
And what are they looking for on the tax return? So
on tax returns, man, honestly, we are looking for any type of deductions that you might be taking, any losses that you're filing. Those are not deal killers per se for wage earners, but many times you see in self-employed borrowers where they're writing off a lot of their income. And if they're doing that, unfortunately, we have to use what is their adjusted gross income. So you can find yourself kind of in a bit of a pickle if you're self-employed and you're writing everything off. If you're going to be buying a home, you need to prepare to file some income so we can actually use that.
So on your gross income, say they're making $60,000 a year.
Sure.
What what may they qualify for from a price point?
Man, it's hard to say without knowing that if that person has zero debt, then you're looking at 60,000. Let's just say that they're looking for maybe $1,500 mortgage payment. That's quite possible if they have zero debt, right? Because you're talking about at 60 grand, it's $5,000 a month. They don't have any car notes. They don't have any student loans. They don't have any credit cards, anything like that. We're trying to get them to the point to where we can stay below 50% of their income. So at $2,500, that's going to be that 50% max for that individual. So if they have anything additional, so let's say they have a $400 car payment, so now we're not at $2,500, we're at $2,400 is what they can qualify for. So that's kind of how we back into it as far as what number they can actually qualify for, because it's based on their overall gross income.
Yeah, and the debt to income ratio always seems to kill people.
It can, and in this day and age, a lot of people feel like student loans are a deal killer, but they're really not. If you have your student loans set up to where you're making payments on them, the biggest thing, people just try to defer them. Defer. And the hard and fast rule for the entities are 1% of the balance. So if you have someone that's got $100,000 in student loans, I have to count $1,000 against them for their monthly debt, and that could actually end up killing their buying power.
Okay, and what's the best advice you can give to an independent contractor? Because don't expense everything.
What once they know that they're in the mind of buying a home, you got to file income. Now, there are some programs that will allow those people to, I would call it non-traditional qualifying. So like bank statements. There's even some stated income programs that are coming back, but those programs are very strict on their qualifiers. So you got to have a specific credit score. You got to put a larger amount of money down. So you're talking anywhere from 20 to 30%. And then the interest rate's going to be higher because it's a higher risk loan. So not to discourage anyone that's a 1099 or self-employed, but if you can't prove the income, then we have to do less traditional options for you.
Okay. Is there any other thing that you could suggest to an independent contractor? Just good practices? Because we have a lot of self-employed people, independent contractors that come to us. They're running a nice little successful business, and they're just not in a position where they can buy a house.
Well, that's only because they're writing off their income. If they don't write off their income, then they can qualify for buy a house just like everyone else. But you got to pay your taxes based on the income that you have. Both times. It can't just be convenient for you to write everything off and you don't make any money, and then now you apply for a loan. Now I make $100,000 a year. You just have to decide which way you want to go. Now, there's a lot of self-employed people buying homes. That's not a disqualifier to buy a home. The deal is they get in their mind that they know that their interest rate is going to be higher, and they've got to put more skin in the game. So it can still go down. It's just not going to be your 3% down program or that kind of deal.
Right. And then another question that we're asked all the time as an agency is, my lender or my agents, they're not helping me. That they've been pre-approved, and is it too late for me to, change my agent or change my lender?
Oh, yeah.
What's your sort of feeling on that? They've got a pre-approval letter or they've got an approval letter, and they come to you and say, I'm not real happy. My previous lender hasn't done what they said they're going to do. Right. I can't contact them. I can't communicate with them. They're not returning my call.
I always take that with a grain of salt because liars are liars, right? You never know what the reason is really that lender is not calling them back or that lender's not working with them. Sometimes they get busy, and honestly, it's happened to me. I would prefer someone give me an opportunity to fix it before kicking me to the curb. But in the case that I get someone and they say, hey, I'm not happy with this lender, I'm not this, okay, I always ask the question, well, what happened? How far along did you get? Did he tell you that, how much you qualify for? Did they pull your credit? Just to kind of get an idea as to what's happened. Because as you ask those questions, you can kind of understand where they are with it. Now, if this person's just gone dark and they're not, responding, then, I want to be able to take care of the customer, especially if he's from a referral partner of mine, and then we can get them, keep them on the track for home ownership. But I'll take it, but I do ask questions just to make sure that there's not something, because I don't want to have them switch to me and then they end up running into the same problem that they had with the lender before because they didn't share with me the reason why it got off the rails before.
Okay, so if somebody comes to you with a pre-approval or an approval letter from another loan company, you can't use that, can you?
I can't use their letter. I'd have to do my own.
Right, which means that you've still got to bring up...
I've still got to pull their credit. I've still got to get their documentation.
Does that hit their credit or is it a soft pull?
It's going. Anytime you get a lender pulling your credit, it's going to be a hard inquiry. Anytime.
And it's going to hit that credit score.
It's going to be on their credit report. Now, the deal with the credit score, they get really concerned about that, and it's not as much of a hit as folks realize. And if you got good credit, it's not that big a deal anyways. Your credit score will show a hard inquiry, and it could temporarily cause it to go down, but that's usually after the mortgage is obtained. But it comes back. The further out that inquiry is, the less that it affects your credit score. So it's not like a hard long-term deal. It's like less than 10% of what it'll affect for the score.
Okay, because we have a lot of people that call us and they've had a bad experience with another lender. And some of them, because people don't understand the stresses of buying a new house and the experience that it takes, it's the biggest purchase you make.
Right.
And they don't understand the process that you go through. And they might be working with a family member that perhaps just doing it on the side, a side gig or whatever. But if you're working with a good agent, then hopefully they'll take that stress from you. They get to the point where they turn around and say, well, I had a bad experience with XYZ, and then they decide they don't want to buy anymore. Mm-hmm. It's so difficult
disenchanted
to
with
sort
the
of
whole
get
deal.
Right, it's like, oh, it's not worth it. This is more than I thought it would be. And we have people that come to us and they'll call up and they'll say, well, can you give me some advice? Because I've been working with XYZ and we don't feel that we've been represented, or they're doing a very good job. Right. And as I said, through professional reasons, we can't comment. So, we can give them advice and say, look, as you're represented by that agent, then you need to contact that agent and discuss your differences.
Right.
And then they've been approved with somebody else and they've had a bad experience. And there's nothing frustrating from an agent point where we might say, they'll say to us, well, I've been pre-approved, and they come to us. And we'll turn around and say, well, I would suggest maybe go to James.
Right.
And get an approval with him just to see if you get a better rate.
Oh, yeah, absolutely.
And they're like, oh, no, I don't want it to affect my credit score. Yeah. And yet I know that there's problems in the future from a point of view of communication between the lending institution and us. And I know it's going to be difficult for them, and they get frustrated. So it's a little bit like going down a cul-de-sac.
Right.
We know where it's going, but then they get disenchanted, whatever reason, and unfortunately they can't get a deliverable on that. So basically, with another lender, they come to us and they say, okay, I've stopped my relationship with my previous real estate agent or my previous loan officer, and then basically, I'd like you to go and show me another house. And then we basically come to you. You have to still evaluate everything, issue that pre-approval, correct?
Yes.
Okay, and I think that's important for people to understand. And then the other question that what?
Go ahead.
The other question that a lot of buyers come to us, if that's the case, they say, well, will I have to pay a termination fee to the previous lender or the previous agent. And that may apply. I mean, that may apply if somebody signed a buyer's rep agreement and there is a termination fee from an agent standpoint, they may have to do that.
This is true. I mean, it's kind of one of those, what you eat the big frog first. It's not delicious, but you got to get it done and make contact.
And sometimes it's better off for them to do that.
Yeah, I agree.
Because if they're there at the beginning, then there's not so much pain later on in the deal.
We had a couple of horror stories, of course, that we this specifically with loan officers. People, of course, you do a bad job, and people are going to blast you. That's why it's important that we always talk about, you and I, giving good service. If you give good service, then it'll follow.
It's value. You've got to give them value at the end of the day.
But I was just going to read this this little review here. Got totally screwed by our loan officer. What are our options? And that kind of goes along the lines of what you mentioned. So I think people, they have a bad experience and then they go through it and it sucks. So I say she because I would assume this be some woman. But anyways, hello everyone. We're first time home buyers. We have a total jerk of a loan officer. We did a maximum interest rate lock for about 2 months ago for 4.65 with an agreement of interest rate were to go down before we close. We could lock in a lower interest rate. We'll close on the 15th and we're getting close. We spent the last week chasing after the loan officer. Lots of ignored texts to ask about lowered interest rates. For example, a bank called us and offered 4.25. No points, lower fees overall. We looked over everything. However, the closing will be pushed back until the 21st. Our loan officer finally called us back Friday evening after the markets closed and said the best he could do is 4.5. The worst, though, is his attitude. He knows we're in a tough spot and the closing date's so close, and he's very, quote, sucks to be you, I can't do anything. So I guess the only options I'm seeing are to go with this a-hole at 4.5 or change banks and push out our closing. I'm guessing this may spook the owners, though, since we are changing up everything so close to the final stretch. Any other suggestions? Is refinancing potentially an option for the near future? Please help. Thanks. Edited to add, we've noticed as a habit of ducking calls when the rates are low, and then he resurfaces when they go back up. So in a nutshell, this person is basically just saying that this guy, and you hear that all the time. Loan officers they go incognito, they disappear when it starts to get tough. And in this case, their rate, and this doesn't happen very often. Their interest rate was able to be floated down, basically, depending on what the market was. I think this was less of that and more of somebody else just kind of called them when as they went through the transaction and just offered them lower. And then now she has buyer's remorse and she wants to get it lower. Now, the fact that he wasn't answering the phone call, that's not acceptable. But I personally would have did all I could to get them as close to that 4.25 or whatever.
Or even give them options.
Give them some options. Hey, listen, if we do this, it might cost you a little bit more on this deal. But that it happens all the time. But I wanted to read that because I know you made mention of having bad experiences, and that was one that popped up for sure.
But on the payment itself, there shouldn't be too much of a difference initially from 4.65 down to 4.25.
It's not going to be much of a difference. Payment wise, it may be $30. It's not going to be a ton now, depending on how much they were financing. The larger loan amount, it could be more, but it's really, in this point, I think it's kind of getting that $1.99 feel. You get a little bit lower,
and that's one of the problems that some buyers get, though, because they get sidetracked on the interest rate, but the money's so cheap at the moment that sometimes all you're talking about is $30 or $50 a month.
Not talking about much at all. And people feel like throwing a bunch of money down makes a huge difference, where it really doesn't make as big of a difference as you think.
Right. And I know you and I bought an investment property. You say I beat myself up all the time, but I do, because I should practice what I preach. But the truth of the matter is, when I bought, the investment property that I closed on in 2019, you said to me, and I made the same mistake.
Right.
I was wrapped up on the interest rate, and you gave me the interest rate. I think, I don't know what it was at the time, but basically I said, well, I want to keep my monthly payments down because I wanted to keep cash flow in the property because I had other projects going on.
Mm-hmm.
And I said to you, well, how much would it cost me to pay it down? And for me to pay it down, I think it was $9,000.
Right.
So I took money from my 401k and paid that down. And then as soon as we closed on that, the interest rate come down.
It dropped.
But even the amount, I didn't do my research, in all fairness. I should have been wiser for what I do. I felt I should have been a bit more patient, a bit more educated, because I got carried away with the emotion.
Well, there was a lot of factors in there too.
There was a lot that was going on at the
Right.
time. Not to make excuses, but the truth of the matter is, all it made was a payment of $100 a month.
Right.
So for me to get that back basically takes 90 months.
Exactly.
And the truth of the matter is, I think I'm hoping to get that paid down or paid off completely in the next 18 months. I'll have it paid off.
So was it even worth it in the first place?
No, it wasn't. I would have been better off just leaving it.
Hey man, your friend tried to tell you. He did, and he tried to look out for you.
Which takes us back. Find a good loan officer. And,
Absolutely.
take their advice. And going back to what you said, just a general point that we teach all our agents at Olympian is people want to tell you the good stuff.
Right.
But they don't want to tell you the bad stuff. It's only the professionals, in my opinion, that can tell you the bad stuff because they've got the balls to do it.
Right. I agree.
And that's part of being professional. And it's a little bit like, that's one of the reasons why I came out of coaching in the States, because people want to tell you the good stuff, but people, when you tell the bad stuff, all of a sudden you're the bad guy.
Right.
And all you're trying to do is to educate people and say, this can go wrong, so let's not make that mistake. But if you don't say it can go wrong because of this, then you're not educating the buyer. And some agents can't do that. Some loan officers can't do that.
Oh, yeah, absolutely. Absolutely.
Some loan officers won't turn around and say, well, don't buy anything before you close.
Right. No, you're exactly right, because they're so focused on just getting the deal done.
Right. So let's talk a little bit about in depth. Part of the buyer series is let's talk about the different types of loans, but just go into more depth if we can, James.
Yeah, so you've only got 4 products total: conventional, FHA, USDA, and VA. Those are the products. When I say products, that's what I'm talking about. Then you have a plethora of different programs that fall within these. So like a Home Possible or Home Ready or renovation loans that may fall into it. So you'll hear those different things. Those are programs. But ultimately, you'll be given one of those 4 products to be able to get a loan. USDA, VA, and FHA are all government products.
And they're insured.
Government. So FHA is insured. And you have USDA and your VA, that you have your guaranteed loans. And lenders like those because they pay out to the lender a guaranteed portion if you were to default on the loan. The insurance from the FHA product is coverage for the lender as well, which makes it attractive, but it's not the guarantee like the other 2. FHA, excuse me, allows for a lower down payment, 3.5%. It gives options to be a little more lenient on debt to income ratios and even credit scores, because you can actually get a loan with FHA down to a 500 credit score. There's going to be 1,000 hoops you got to jump through, but it can be done. It does require more money down at that income level. At that credit score level. Below 580, it's going to be a 10% down payment. But it can be done, and I feel like a lot of folks don't know that, but they try to get to that 580 mark so you can actually get the full 3.5%, which requires. But nevertheless, it can be done down to that level. The other ones are going to have minimums. So you got VA doesn't actually have a credit score minimum technically. But you'll have lenders that will have what they call overlays to say this is what the lowest score that we'll accept to do a VA loan, which is protection. Overlays protect the lender because they've seen different loans perform certain ways, so they'll put those in. And you have USDA, which you'll have some folks that might have higher, but you're looking at that 640 range or so for USDA. Is income qualifying product as well. And then you have conventional, which will be a 620 minimum. And those are typically because mortgage insurance companies require a 620 credit score. So their minimum is going to be a 620. And in most cases, you will be required to have mortgage insurance on a conventional loan. So that's primarily why you have to have a 620 or higher.
What I'd like to do is to just split it up a little bit. So basically, let's talk a little bit, and let's just keep it at the moment to conventional.
Yep.
So then I can ask you, we can split it up basically.
So
with conventional.
So with conventional, you can get in a conventional loan with as little as 3% down. They created that to kind of compete with the FHA product. 620 minimum credit score because this is a conventional loan. There's mortgage insurance that's required. You can put down as little as 3% or up to however much you want to put down. It is not as forgiving credit wise as far as FHA because you do have to have that 620. But there's a few things you can kind of get around with the property. Property's not in perfect condition. And there might be some things that FHA may not allow. But the conventional piece is an option to use for first-time home buyers, second home buyers, investment properties. All of those are going to be on using conventional. You can get closing costs that are actually paid on a conventional loan. Traditionally, if you put down 3 to 5%, it's going to be 3% is the maximum. But as you put down more money, then you can increase the amount of closing costs that you can actually get from the seller. That'll cap off at 9%, depending on how much you're actually putting down on the transaction. But conventional loan, it's going to be a fixed rate typically, although you have some options to do an adjustable rate on a conventional loan. I would recommend knowing what you want to do before you do that, of course. But the conventional product is one that's really kind of been around forever, and it's a lot of people get it, and you don't have to be a first-time home buyer to get it, but you can be a first-time home buyer and also get it as little as 3% down.
Okay, and let's talk about some options with that. With a conventional loan, say we buy a house in May, and let's say the interest rate was 4.7%, and then we decide to refinance June. It really isn't worthwhile doing it at that point.
On any product like that, I wouldn't suggest
say
that.
The interest rate goes down. I mean, it's just not.
Unless it was a significant amount. Let's say you had 4% and it went to 1.5 or something, or even 2 maybe. You might do it, but what you pay to do the loan, you're going to have to pay again. So you want to just look at overall what it's going to cost you. I actually talked to a previous customer out of refinancing just a month or so ago because she told me she wants to move next year. And I said, well, listen, if you're moving next year, what it's going to cost you to do this loan now, and we increase your deal, your balance, you may as well just stay where you are. You don't have a terrible rate. Stay where you are. Keep paying what you're paying.
Because that's a mistake I feel that a lot of people make because they get these phone calls and saying we can refinance your house and we can get it now for this rate. Sort of similar to what we previously viewed.
It's the fear of missing out.
Right.
Yeah. And
the truth of the matter is people don't understand about them closing costs that we spoke about. You feel that conventional is more of a forgiving process? You think is it harder to qualify for?
It can be harder because the credit score minimums are higher. At that 620 mark, you have to have a 620 period in order to go conventional. But they also have some rules that kind of keeps people out of it. So the ratios, the debt to income ratios, can't be as high. You're looking at just the regular 45% for the maximum debt to income ratio, which you can go up to 50 now on some products, but it's a matter of the overall credit profile.
And just going back to the mortgage insurance is not required if it's over 20%, correct?
If you put down 20% on a conventional
on
loan.
a conventional loan, if you are in a position to put 20% plus, then there's no mortgage insurance.
Required, correct.
Okay. Now, if it's under 20%, the mortgage insurance, how do the rates work for that?
So it's a percentage of that. It can vary depending on how much you put down. It could be as much 35% down to 12% of the actual loan portion of it, and it's a calculation that we use to actually determine what that rate's going to be. But it's all determined on your credit score and your overall loan to value on that.
And is that rate is determined by the loan company, correct?
By the mortgage insurance company.
The mortgage insurance company.
Correct.
Okay, and do you shop that between different mortgage insurance?
I do. I try to shop it to get the lowest rate. You have an option to get for the client, right? Try to get the lowest one.
Okay, and then the other point that I just want to address from an agent standpoint is a lot of buyers are very uneducated, and some agents are very uneducated, that there's some properties that I can buy with conventional. And actually, from an agent standpoint, I prefer conventional because on the whole, I can take that buyer out and offer them more options on a particular type of property. With FHA, sometimes there's some properties that property is not going to qualify. I teach the philosophy called the three circles.
Right.
So basically what you've got is there's three circles that you've got to get. With a conventional, you've got to be able to match the property because sometimes the property doesn't qualify for the type of loan.
Sure.
Then the person's got to qualify for the loan. And that's what a good real estate agent does. Gathers all this information and puts it together so the client's in a stronger position. Then when I make the offer, what I'm trying to do, develop a strategy, which is what the buyer is requesting, putting it on paper and submitting it to the agent. But with a conventional, I feel it will basically offer more options to the buyer to buy a home.
Well, it can offer you more options as far as them being able to purchase a property that doesn't qualify for FHA, but also because a listing agent doesn't want to accept an FHA offer because the house maybe didn't appraise for more.
Yeah.
So there's other there's a lot of different factors that can affect it.
So in summary, I'm just going to ask you some very basic questions specifically about conventional.
Mm-hmm.
At the moment, the lowest credit score you can do with conventional is
620.
620. Debt to income ratio.
Safe 45% can go up to 50.
Okay. And then you'd ask for 2 years tax returns?
Tax returns, W-2s, 2 months bank statements, 30 days coverage of pay stubs.
And then with that, you can basically do just a basic pre-approval.
Yeah, pre-qualification based on that information.
Got
right.
you. Okay. So anything you want to add to conventional, or should we move on to FHA?
Well, actually, conventional, that's what it was, what it's been for the longest. So it's the tried and true option. So in a nutshell, it's the way to go if you can afford to put down what it is and your credit score is where it needs to be.
There are programs at the moment then for the down payment minimum for conventional 3%.
3%, correct.
Which is less than FHA.
It is half a point less than FHA.
So let's move on to FHA. And I said,
Yep.
let's specifically just talk about FHA because that way it's easier for people, to view the video. So with FHA, we're talking minimum 3%, 3.5% down.
Correct. 3.5% down for FHA. You can put down as much as you want above that. And if you put down more than 10% or more, you actually have the opportunity for the mortgage insurance that is required on FHA to be removed after 11 years. So the FHA currently right now, you have mortgage insurance on the loan for the life of the loan. It'll be there if you make that minimum down payment. That's just a rule that was instituted several years back, and it won't ever go away.
Right, and
unless you put
that
down
was
more
changed
money.
to how it was originally, wasn't it? At one time, when you get it down, so you've got 20% equity in the property, then they would do away.
Well, that's
with
been the
mortgage
case for
insurance.
like your conventional financing, but it was kind of that window with FHA. It was not so much based on the value, but more the time. But now that timing is based on it's still in place, but it's if and only if you make a down payment of 10% or more.
Okay, so with FHA,
Otherwise, it's going to be there.
So with FHA, minimum 10% down, no mortgage insurance.
No, there is mortgage insurance,
But
it'll just go away
after
the 11 years.
how do they come up with 11 years?
I know, right? It's kind of weird.
It's a sort of funny number. Maybe why not round it off to 10 and make it easier for home buyers? And just so everybody's clear, the mortgage insurance covers people for...
It doesn't cover people at all. Mortgage insurance covers the lender. It is protection for the lender for default from people. So if you get this house this year and you're making your payment, and 3 years from now you lose your job, or God forbid a spouse dies, you don't have that income and you can't afford to pay it anymore, but you're still in a position to where that mortgage insurance is covering your default on that loan for the lender. So it's covering the lender, not the consumer.
The point that I have never understood about FHA is it's an FHA insured program, but they still want you to take out mortgage insurance.
Well, the insurance
Isn't that called double dipping?
Well, it could be. The insurance itself is protection for the lender, and it's basically a big insurance policy that's the government insured. So you still got to pay for the insurance. Yeah, you get insurance on your job, but you still got to pay for it. They pay a portion of it, but you're kind of co-paying for it overall. So that's the idea behind it.
Okay, and minimum credit score at this present time for FHA loans?
500.
That's
That's
low.
insane, right? Because someone with a 500 credit score. Now, here's the deal. Sometimes people file bankruptcy or, something happens, and you can look at a credit report and tell that something took place, some type of event took place and basically their score dropped. It's for those types of people, that minimum, because that person may have been paying their credit on time and there hadn't been any issues at all. And they just had a hard spot, but now they're back on track and their score just hasn't bounced back, but they've got the money to put down. That's why you can actually do that with an FHA loan. But this is not for your regular person that never pays any bills, got, collections and foreclosures and all that kind of stuff. That 500 credit score is the minimum. You will find that most lenders will have an overlay for that and won't go down that low. So 580 is usually kind of that window. 580 to 620, somewhere in there, will be that window because you can put down 3.5%, which is the minimum.
And debt to income ratio?
So you can actually go up to, believe it or not, 56.99%
So
on
that's
FHA.
that's higher than
It's higher than
conventional.
conventional.
But FHA can only be used
To
by
buy
homeowners.
primary residences. You can't use it for any investment properties, second homes.
Let's just get that clear to everybody. I think.
You have to be living in that property. That's what it's for. That's what it
So
was
it's a
created
home for home
Right.
time residents.
And it's for first time home buyers. It's for even second home buyers. Not second homes, but you bought a home a second time. But it's really truly just it's a little bit more forgiving product that we can use to get people into homes.
Right, because that's one of the things when people say to me, well, do you know any first-time homebuyer programs? And I say, yep, FHA.
Right. Yeah.
Because FHA is designed for a home buyers program.
And people feel,
I think it's overlooked.
People will say that. They'll say FHA is first-time home buyer, and it is. You can use it for first-time home buyer, but you can also do conventional for first-time home buyer. But the deal with FHA is it's been there, and it's kind of been that low down payment option because conventional for so long did require 20% because there weren't mortgage insurance companies, and then when they put 5% on, it was still a higher down payment than FHA. Then they got smart and they started competing and said, hey, we're going to do a 3% option. So FHA has a little bit of competition in that space. But it still does really well. The FHA product does really well. They do have restrictions on sometimes in properties, specifically like burglar bars. You can't have burglar bars.
I was actually coming to that from an agent standpoint.
Yeah.
That's why I say to everybody, find an experienced agent that knows that, because sometimes you're wasting your time. You qualify. A lot of people get frustrated when we're on the phone with them and they call us up for the first time. We basically say, are you qualified for a loan? And they say no.
Right.
So, of course, we advise them to go to you to get qualified, or, just bring us an approval letter. That sort of turns people off, because all they want to do is look at the red door or the granite counters.
Right.
Then the next step is we say, well, what did your loan officer approve you for? Well, they approved me for an FHA. And then they call us up. They say, okay, I've got my pre-approval letter. They send it to us. And then they send us a list of properties, or we send them a list of properties, what they want to look for. Or we normally send them a list of properties in a particular area.
Right.
Then they say, I want to look at this, 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 and this. But that particular loan will not qualify for that type of property.
Absolutely.
And sometimes that's frustrating for them to understand. And then, we normally do a conference call with the loan officer and ourselves, buyer, so it's fully explained to the buyer.
Sure.
But sometimes that's frustrating. First,
I can understand. Definitely can be.
So, there are requirements that FHA have to buy a particular type of property. Sometimes they can be remedied. Sometimes, as an agent, because we represent the buyer, that we can call them up and we can even speak to the listing agent.
Right.
And we can speak to, even sometimes when there's not a listing agent, we can speak to the seller and say, well, we need this done. And sometimes we have to negotiate to get that done for the buyer. So it's a workable opportunity for the buyer to buy the home.
Right. Absolutely.
Yeah. And then, so now let's move on. Let's move on to USDA.
USDA. It's going to be very similar to your government product, your FHA product, with the exception of it does allow for zero down payment. The only caveat is it has to be in what is required, a rural area. Because you'll hear that RD, rural development, used kind of synonymously with USDA, but it has to be considered a rural area. So you have some areas on the north side of town, some further south, in our area down, Brazoria County, even out east in that out past Mount Bellevue, those kind of areas.
Now, does that go on area, or does that go on acreage? Or?
It's area, so it's depending on.
So if I'm lucky enough to have 3 acres in Houston, still not going to qualify.
Not necessarily, because it could be 3 acres, but if it sits right next to NRG Stadium, it's not rural.
Right.
Yeah. So the easiest way to do that is to actually go to the USDA website, where you can actually put the address in for the property, and it'll tell you right then and there if the property qualifies for USDA, and that is based more on the property, not the individual.
Okay.
Yeah.
So it's zero down.
Zero down. There is what they call a guarantee fee. It's kind of like mortgage insurance, basically, on it. There are also some income limits for USDA. And again, you have to put those, if we put those into the system, whether for the property, it'll tell us where that property sits and kind of where the minimum or the maximum income is going to be for that. And they include household.
So there's a lot of requirements for area.
Right. Area.
And the rural aspect.
And the income piece of it. So let's say if you're living and let's say your parents live with you and they're getting a Social Security check for $2,000, that money is going to be included and calculated into the overall household income for that, and it may kick you out of qualifying for it.
But when you said there's restrictions on the income, sometimes you can earn too much.
Absolutely.
And not qualify.
That's mainly the case. Usually you earn too much, you don't qualify. If you make too much money.
Wow. That's that's actually a strange situation.
It is.
It
is. But it's 100% financing. So they want to make sure that it's for those folks that, need it. And that it goes and does what it's supposed to do.
Okay, and credit score?
Credit, so 640 has kind of been the minimum that I.
So that's pretty high, really.
Yeah, it's you can't really again, it's a higher risk deal because they're getting you into the house, and you're not really putting any skin in the game on there. So you wanna have that idea of, this is a product that if I'm buying a house, I'm getting into it for a little bit of nothing. They want to make sure that your credit score is performing better than just your traditional regular, 580 credit score FHA.
Is there any requirements for the condition of the property if it's a rural area?
Yeah, you want it to be livable, and that's going to be the case for all of them, really. You want it to be livable. The only caveat you'll run across from conventional to FHA to USDA is that there's going to be real heavy eyes on any hazards dealing with FHA,
Safety
USDA.
hazards?
Yeah. So we're talking about exposed wires, plumbing, any electrical issues. Funny enough, in our area, if there's no air
I
conditioning,
know, we laugh about this all the time, don't we?
if there's no air conditioning, it's not a big deal. But
You
if
need
there's no heat, they're like, nope, sorry, you need some heat. I'm like, wait, just open the door. I mean, it's hot outside. You don't need stinking heat, and not
Unless you're in the Texas freeze, of
right.
course.
So it just kind of depends on the product. But it's always good, of course. As an agent, you want to work with a loan officer that kind of knows what to look for, and don't be afraid to call and ask.
Right.
I get calls all the time from seasoned agents. Hey, you think this house will qualify? Blah blah blah. And I look it up and I say, oh, nope, this is why, and I'll tell them. So we might have to flip it to conventional or.
So if
whatever
a
the case
buyer
is.
comes to you and you qualify them, do you qualify them for a conventional FHA, USDA, or do you look at everything? One of the questions you ask is, well, I'm interested in buying a house in this area, and say it's a rural area. You then say, well, you could use USDA and you could also use FHA and conventional. I mean, how does that work?
How do you determine that?
Yeah.
So for me, I'm not qualifying a property at all. So anytime I'm talking to someone,
So that's where the agent.
Absolutely. I'm talking to them about their buying power. So I try to give them options. So I'll run it, if it qualifies, I'll run it conventional, then I'll run it FHA. Just to see. Of course, you ask them if they, you might say, well, where, you're looking at on living. And if they say, oh, I want to live in Waller, Texas. Okay, well, they might qualify for some rural or USDA financing if you ask that question. But ultimately, what I'm trying to do is just to get them qualified to buy a home and see how much buying power they have, be that FHA or conventional. Because we technically, we're supposed to give them options anyway, so they kind of know what to look for.
Yeah, we had one buyer that was USDA qualified, and we presented it to the agent, the listing agent. The listing agent said, "What's USDA? I've never heard of it." There's a lot of agents that really
they don't know.
They don't.
That's unfortunate.
They don't. So I do think they should have a general knowledge, and that's the purpose of this video. But the truth of the matter is, it's really, that's why they need to work with a loan officer.
They do.
Because it's all about teamwork. We're going back to, I don't want to sound repetitive, but that's why I think it's important to have a good relationship with your loan officer.
Absolutely.
And the agent. And, the buyer should feel comfortable with everybody.
Right.
With all the agents that work at Olympian, I always say to everybody, give people my direct number. So if there's a problem, I can get involved and explain it to you, because sometimes agents don't explain things properly. And I do think it's important. An educated buyer is a better buyer.
Agreed.
So, okay, so let's move on now. Let's move on to VA.
VA, my favorite loan. It's for our veterans. Thank you for your service. And it is 100% financing. There is no credit score minimum for it, although there are layers that'll be put on, or overlays, or depending, it'll vary per lender. But the deal with VA is it's pretty common sense. It's one ratio, and we use what's called residual income. So this is based on, after all your bills are paid, what's left over.
Spendable income.
What's left over, and if you have that enough of that left over, then more than likely you can get the deal. Now, VAs are guaranteed loan. You have to be a veteran. You have to have served in the military for at least 180 days during peacetime, or 90 days during wartime. as a full-time military now. The reserves, they have more requirements if you're a reservist and never served, but you can still get it. And I like it because it is 100% financing. There's not a monthly mortgage insurance, but there is a funding fee that they charge for VA. And
so is that a one-time fee?
It's a one-time fee that goes towards your closing, and it is financed into the loan. If they choose to do it that way, most people do. You finance it into the loan, but they don't pay anything else monthly. So it's a pretty cool deal for. And what's even cooler, if they're disabled, that funding fee is waived. But not only don't they pay anything monthly, but if they have a disability, I think the minimum is 30% or higher, then you don't even pay the funding fee. So they can get into the deal without having to pay the funding fee and no monthly mortgage insurance. So their buying power will be much greater than just a regular traditional person, because they don't have, an extra $100 or $200 a month eating away at what they actually qualify for. That can go towards their mortgage.
Right. Now, one of the items that I think we need to discuss with VA is, at one time VA were very strict on the condition of the house. The seller could not do repairs. But they've made that a little bit easier, have they not?
Well, with the times, it's not as difficult as it used to be, and also it's not as difficult as far as the seller having to pay for certain things for the buyer. They've allowed them to do certain things.
And a termite inspection is required.
It is required. It is definitely required. There was a lot of different little non-liable fees that used to exist that they've kind of let up a little bit and given us a little bit of wiggle room. As long as you're not charging this amount, you can charge this. So we have a little more freedom with that, but they have kind of lifted some things to make it a little more difficult and not requiring so much from the seller.
Because at one time, the seller had to pay for all the repairs.
Yeah, because there were fees that they wouldn't let the veteran pay for. So the seller had to pay, or a lender had to eat it, or whatever the case is. And when you put somebody in that situation, they're like, no, I'm not accepting his offer. Now, here's the unfortunate thing: many agents have not updated. They haven't downloaded the new update. So they still think that way. So when they get a VA offer, they're thinking the old mindset of how things used to be, with the exception of the termite inspection, because some will miss that as well. And that is actually a required kind of deal. But I think it does everyone a good job to get versed in these products, at least know what you can accept as an offer for the financing.
One of the big mistakes that agents make is they give the buyer a list of inspectors, and not all inspectors do termite inspections.
Right.
So a versed agent and an experienced agent will always give a good agents, determined by TREC, we're supposed to give them, a list of inspectors. But what the agent needs to do is to earn their salt and basically check off the inspectors.
They do a termite as well.
They do a termite as well.
Yeah.
Because if not, they've got to get a different person
exactly
to do it. And sometimes that's an additional expense for them.
It is.
So I think it's important, and it's a big mistake that that some agents make, that they need to get an inspector in there that can do it all in one grab.
Right. I agree. That makes it so much easier.
Right. So basically, they have lifted the restrictions for what the seller does not have to pay so much for repairs now.
Right. Well, the repair thing is kind of, there's still some things that aren't acceptable, but the non-allowables is the biggest piece, where they were saying that the seller had to pay for certain things because the buyer couldn't pay for it.
Right.
That is kind of giving us a little bit of freedom.
Insurance.
No mortgage insurance on
just
the
one-time
fee, the one-time funding fee. Correct. And they can get closing costs up to 4% paid by the seller as well. So you still have an option to do that. There's not as many appraisers that are VA certified either.
That's where actually I was going
next. That's a big deal that we deal with.
Not all appraisers can appraise a VA loan.
Yeah, for a VA loan. They have to have a certification to do a VA appraisal, which is cool that you got that exclusivity. But when you've got a small group of guys doing it, it pushes up the time and turnaround for a VA appraisal. So just be prepared for a little bit longer.
A little bit longer wait.
Yeah.
Okay.
So that's
and if an appraisal is done on a house from a VA appraiser, how long does that appraisal stay on the house and in the system?
120 days.
120 days.
Right. Same with FHA.
But that's come down in time. At one time,
Yeah,
it was
it's been 6 months.
Wasn't
It's
it?
been 6 months and about 120 days. What it'll be, because there's case numbers assigned to those products. USDA as well. Yeah, USDA, VA, and FHA. You got a case number assigned with them, so that case number is assigned to that property. So that's why when you pull up that case number, that appraisal is going to be assigned to that. So many times we have to get them switched.
And the downside to that is, unfortunately, because of that requirement, if another vet comes along after that, it puts them into a detriment, doesn't it?
It could, yeah, it could do that. But I mean, to their win, as long as the seller's willing to play ball, they can get into the whatever the value was on the previous appraisal.
Can a vet put more of a down payment down?
Sure.
So there's nothing stopping them doing
Nothing stopping them from doing that. If they want to try to get their payment down,
it's no credit score.
The minimum, there's no real true minimum.
Okay.
But you will have lenders that will have an overlay for them for VA.
And the vet can pay closing costs?
Yes. The vet can pay closing costs. Can't charge a vet like you can charge everyone else.
Right.
So there's limits to what we can charge. Of course, what we can charge, but they can and will pay closing costs.
And we've spoke about this, but sometimes there's vets that come in and say, I want to do a VA loan.
Mm-hmm.
And we do a VA loan, and then for whatever reason, they turn around and say, oh no, I've decided I want to do a conventional. Or you've basically went to them and says, well, you can get a better rate or whatever with a conventional. What are the instances where that applies?
I've never had anyone switch from a VA to a conventional.
So you still feel that VA is the best way to go for a vet if they can?
Here's the thing. The deal with the VA, there is no money down required. And if you can get them qualified for it, as long as they qualify, why not? It was a benefit that you get for serving, putting your life on the line for the country. Why not use your VA benefit?
Right. But there are loan officers out there that do persuade some people to go from a VA loan.
I think that comes from an education standpoint, though. Sometimes they don't understand it completely, so they try to sway them to something that they're more comfortable with.
Right. Okay. And now I want to move on to what are the things that a buyer needs to do to make the loan work for them? Okay, so in other words, what are the benefits between a 15 and a 30-year mortgage? And how is the monthly payment different? What are the circumstances that it's better doing a 15-year or it's better doing a 30-year?
Well, if you ask Dave Ramsey, he's going to tell you 15 years is the way to go. But a 15 years is not for everyone. It's going to increase your payment significantly. So I don't, very rarely do I get someone that comes to me to say, oh yeah, let me get that 15-year, blah, blah, blah. You get those on refinances a lot. Or people, they've been in their home for a while, and maybe they don't want to go back up to a 30. They want to take a 15-year. I tell people, we'll do whatever you want to do, however you want to do it. But if you amortize it or take a 30-year note, you can still pay it off in 15 years because there's no prepayment penalty on your primary residence. So why not take the 30, which isn't going to be a drastic difference in price, and just pay it in the 15. You can actually do that and not be obligated to the higher payment. If you go with a 15-year AM, you're going to be stuck with a 15-year.
Right. Absolutely.
For sure.
One of the things that I've done whenever I've purchased properties or investment properties, I've always gone for the 30 years. But what I have done is I've paid it down actually bi-monthly, which is sometimes an option that companies do. And it saved me a lot of money over the time. I've always done the 30 years, but then you've got the option, if you're in a position to pay that little bit extra, to go pay that bi-monthly payment.
That bi-monthly.
Or even pay an additional payment per month.
Per month, exactly.
Which has got it down. And I'm personally in a position at the moment, with the loan that you did, for the investment property that I bought, as I said to you, we should be in a position where that's paid off in another 2 years or 3 years.
And that's beautiful.
So
because it's all profit at that time.
It was a 30-year note that I've ended up being in a position where that will be, good to go and paid off.
Good.
And then it's an equity property, and so are there any instances? So there's no instance really where you would recommend to somebody to pay it in a 15-year?
I would not. That's a personal choice. It's kind of like sugar or no sugar. It's your choice. You want it or not.
And what would you say is the difference between you as an independent loan officer and going to a bank?
So the biggest difference, if we look just line by line, I'm licensed. I had to get licensed, had to be tested, and to get a license to originate in the states that I do so. If you're working for a bank or you're dealing with an originator from the bank, that doesn't make them any less than I am, but they're working under a bank charter, so they're not licensed to do it, but they may be able to do loans in every state because they're under that bank charter. I worked for a bank for a long time and closed a lot of loans, for people. But you find
but the banks can only offer their products.
Only offer their products, absolutely.
So the buyer or the client is actually at a disadvantage in that case, aren't they?
Well,
I mean, surely if it's a more competitive market and I'm able to offer it, it's like me saying to a client, well, this is the house you're going to buy. This is the only house that you can buy. But if I can give people a selection of properties, then there's a better choice and a better chance that we can negotiate.
Right. So we're all going to be having the same 4 products, right? But there's different programs that you might have in a bank. For instance, there's a bank that's south of here that offers 100% financing. It's a portfolio type product that they're going to keep on the books there in the bank. You get that type of thing when you go to the bank. You also get it's a big institution. It's a big brick and mortar building. So there's some costs associated with it. So you may not get the lowest interest rate available. It's not going to be super high. It'll be competitive, but someone may be able to beat it because you don't have the overhead. I don't also have the drive-through with a bunch of tellers going through in the lobby with the peanuts and suckers for the kids. So we can use that money to actually go into pricing the loans and give that benefit to the consumer versus having to be a little bit higher for them.
So you as an independent loan officer, if you know there's a good product at a particular bank with 100% down, whatever, can you offer that? Can you go to that bank and can you offer them?
Excellent question. So depending on the program, there are some banks that we do work with. We can price on their particular product, and through what they call a broker channel. If there's a company that's offering something and you want to have a relationship to be able to use that, you can set up a relationship where you can offer their product. But that's if you're away from the bank. You can't do that as a bank employee. But in my position, you can actually do that and offer some other products because we do have broker options to do that. But
not all banks offer that.
No, there's no bank that offers. Typically, the banks are going to offer their bank programs and not have a setup for a broker channel. There may be some out there that do, but typically the big banks that we deal with here in our area, they're going to just be dealing with what they offer there in-house.
And how about credit unions? Do you ever give people the option to?
So some credit unions offer good products. They usually offer pretty good rates. But again, you're going to go into the mix where it's, for lack of better words, it's kind of how do I call it? Kind of a call center type setup where you may not go and get an individual loan officer every single time. You may deal with a loan officer. There's one credit union that I use that they do have them sitting inside the office or the bank institutions, and you can go in and talk to someone.
That's one of my biggest gripes, though, for some of the banks and the lending institutions. They use a central lending system. Mm-hmm. So you go in, you see your personal banker, you apply for the loan,
right?
And they give you a reference number. Then they give you an 800 number, which you can never get any answers for. It's difficult to get, and in the meantime, you've got a contract that perhaps you're not even pre-qualified for, then your earnest money's at risk. We had one the other day from one of the big banks.
Yeah.
And then it's not the fault of the buyer that they can't close. It's the fault that there was a problem with the bank not getting the documentation and everything else in time, or the paperwork's incomplete. And then the buyer's put in a position where they're losing their earnest money. And it's so frustrating because the buyer's doing everything in good faith. The agent's doing everything in good faith. The particular bank, and it's a well-known bank.
And you can't really blame the buyer too, because let's say they've been,
well, it discouraged them, to be perfect. It discouraged them,
right?
And they said, this process isn't what I thought it was.
Right, but they've been banking with this person for, or this company for 10, 15 years, so they figure, they can handle my mortgage too. And it's not always the case, the same when it comes to the mortgage.
So what do you think is more attractive for them to use big group loans?
What makes them attractive?
What makes a buyer come to you, and what makes you more attractive?
Oh, okay. Well, my good looks, of course. But I will say, the experience that you'll find, you can always look up and do reviews, look at reviews to see my profile on Google or on Zillow, where I've actually serviced, customers. But more importantly, just giving a phone call and just asking the questions where I can actually give you a certain level of comfort in knowing that I will handle your transaction properly and do the best job for you as a consumer. That's really, when I talk to someone, that's what I'm trying to do. I'm trying to win their business with service. I don't get every deal from every person I talk to, but I try to at least answer their questions and put them in a position to where they know more when they left me than they did when they called.
Right. And obviously the communication is important again.
Right.
I always come back, communicate. And that's the part that's so important. And obviously the biggest point that I think you offer, and we go back again, is that value portion.
Oh, yeah.
Because without that value portion, that really is when it starts to fall apart. And what would you say is a good client that comes to you, where they, where you can get them their best rates? Obviously, you've got good credit versus bad credit.
Well, I would say someone that's willing to listen, honestly. Because, of course, people will come in and they have a little bit of knowledge because they're Google warriors and they've kind of looked up a few answers. But if they can just allow me to talk to them, to kind of build some rapport and to trust them. And
put a plan together, really, and a strategy. It's the same as what is with a good agent.
Allow me to be able to lead them, to keep them on the path, because ultimately we both want to get to the finish line. I think someone that comes in knowing that they want to get a home, and they're willing to do whatever it takes, within reason, of course, to make that happen. Because that's what I want to do. And I'll keep going until they quit or fire me.
Okay. If somebody comes to you and their credit score is good, obviously that's an easy possibility of moving forward. If the credit score is bad, then what are the options there? We
can actually get them set up with a company that can help with some of that credit. Kind of help them start to set up budgets and help them to remove any erroneous or incorrect information on a credit report. That is what I would do. I would get them with that company because that's what they do 24/7.
I think a lot of people make mistakes as they go online and then they see some of these companies and then it's not put together properly. There was one company I seen the other day. Well, we can remove all your bad debt.
Right.
Then if it's not done properly, you can actually put them in a worse situation.
It can, because some of them even ask for these big, huge lump sums up front, and then they don't end up doing the work properly. But these people are out of money because they paid $1,000 to get this stuff off of their credit, when really they didn't have to do that. They could have just went to a company that'll just take a monthly fee and to get started on the work.
Which is a service that we offer.
Exactly.
And when we do that actual cost, we actually, if they work with us and they work with you, we rebate that back to them, don't we? we sort of make a contribution to help them be in a position and live the dream and get their first house. And so now let's just move on, and let's just move on to, so basically they get approved for a house. We're all ready to go. We make the offer on the house. But obviously we'll have this conversation before we make the offer in the house. If it's done properly, we will go through, and you will go through the closing costs, the down payment, and title fees and such like.
Right.
So how would you go about that?
I would give them, it's just a worksheet. And then basically just kind of depending on what house they're looking to buy or what I have them pre-qualified for, I will give them a sample sheet of what they can anticipate to pay at closing. And it'll just
that should really be done before they start to make the offer. If they're looking for a particular price range, then at least it gives them a ballpark figure.
Absolutely.
That's why it really is very much a strategy on how, it's not a case of just doing it, it's doing it right the first time.
Yeah, and if they do it and they go in it and they find something cheaper, then of course the number will be lower. But I try to give them a sample of something that, okay, this is what I can anticipate if I buy this house.
Right. And what do you think the things that are important, to look out for, some of the common terms that they're going to hear throughout the transaction?
So, of course, little things like points. Like if someone talks about points, those are percentages that you pay. So if a half a point is 0.5%, or 1 point is 1%. If you hear things like that, APR, annual percentage rate, that is the actual cost of the loan, the closing costs and everything at an annualized percentage to determine the true cost of the actual mortgage or what they're actually getting. Of course, appraisal, that's the actual evaluation of the house as collateral for the loan. And it's different than an inspection. It's not the same thing. An inspection is going to be different than an appraisal. An inspection is just making sure that the house is, workable. Well, any systems that are having any issues. When you're doing an appraisal, we're looking at the value of it, of course. So that's little terms that I can think of that you might hear. There's a few of them that you may come in contact with.
Yeah, one of the misconceptions that some buyers think is when you give them a sheet you've got with all their costs on, they come back and they say, well, what's this loan setup fee?
Right.
Doesn't the seller pay all the closing costs? And basically then we have to explain to them and say, but as you're doing a loan, that's part of your cost for the loan officer to put everything together and do all the work that he's doing, to make sure it's done properly, to present it to the lender.
Right.
And I think that's a misconception. Now, if you was buying it cash, then obviously that wouldn't come into play. But I do think it's a misconception of some buyers that they see that loan setup fee and they say, well, why do I need to pay that? The loan officer's putting it together. It takes time to do that.
Yeah, and
it takes expertise to do that.
Exactly, and it'll vary. I mean, you'll see it called different things. You may see origination charges. You may see processing, and it all kind of determines. But the key is that you get something, and then that you can ask the loan originator to explain it to you. And that's what I try to do. Just try to make sure, hey, you got this. It's here. You have any questions about it? I want to make sure you understand it so you know what we're walking into.
And so what would you say is the phases and the process from somebody comes in the door to you, you talk to them, you're working at getting them qualified. How would you say the phases are all the way from introduction to close?
So, I mean, when they're being introduced to me, I'm just meeting the prospect, really. It's a person that has shown interest that they want to buy a house, and I need to determine if they are actually a qualified buyer. From there, I'll get them into the credit process as far as pulling credit and gathering documentation to see
and the way that you prefer qualified. That is for them to go online?
Yeah, absolutely. They'll apply online, and then I will pull their credit once I get the application actually in. Once I take a look at the credit and it's viable credit that we can work with, then I'll request documentation from there. And that list of things that I talked about a little while ago as far as to prove their income, right? Yeah. Once I have the documentation to verify what they've put in the application, then I can issue a pre-qualification letter, and they can start shopping for a home with a real estate agent. Once the real estate agent and them agree to a property and they make their offer, then they'll come to me. Once the offer is accepted, they'll come to me with the executed contract, and then I will, at that point, put them in the system, and then we have a fully disclosed loan application, and then we'll go through the process as far as getting them closed.
Inspections are done. The inspections are done. Basically, if the agent does the job that they should do, they negotiate the repairs. And at that time, the appraisal's ordered,
done.
The survey's ordered, unless it's provided.
And during all of this time, the loan is being processed and underwritten to make sure that there's no outstanding loan conditions or anything like that. So that was all taking place behind the scenes.
That's just to clarify. That's nothing that you do. That's a separate department for the lender.
You don't
they have an underwriting department.
They don't get a chance to meet or see the smiling faces that we deal with.
Right.
But they do. They're very valuable, and we couldn't do our jobs without them. So they handle the processing piece of it, and the file goes through underwriting and comes out with conditions.
And some of them conditions could be the roof isn't good enough, the square footage isn't enough.
It doesn't even have to be about the property per se. It may just be, we need the appraisal, or it may be we need to explain, this job gap, or this large deposit that was in the bank account, or discrepancy on the address from your driver's license to what's on your bank statement. It could be something as little as that, or something as big as you're on your verification of employment. It shows that you don't work there anymore.
Right. As an agent, an experienced agent, I just want to point one thing out: the biggest mistake agents make.
What is it?
Closing at the end of the month. It makes no sense because everybody's scrambling at the end of the month to get everything closed. I highly recommend to people, if they can, even if you could persuade the listing agent to go for a closing in the middle of the month.
Middle is better as far as traffic goes.
If not around the 20th.
Yeah.
Because the truth of the matter is, there's less closing, there's less pressure on people, to do and to move it through.
Yeah.
When I did a lot of work for the foreclosures, when we had the foreclosure crush, the asset managers used to tell us, always try and get it closed about the 23rd or the 24th of the month. So the idea is that when that crunch comes at the end of the month, the ones they were closing on the 23rd, 24th, if there was an extension on that because the lender couldn't get it together, or there was some sort of hold up, then at least you can give them 2 days or 3 days after that, and it's still not at the end of the month.
I got you.
So I really think if you can get, the problem is sometimes you'll get a listing agent and they'll turn around and they'll say, well, we need to get it closed this month.
Everybody wants to close this month.
That's
all. Nobody wants to roll into the next
everything
month.
Comes at the end of the month, and that really can be an issue. Okay, and so basically, when we send the offer into somebody, and basically what does the lender do at that time? So the offer goes in, it's got executed, and you go ahead, and if a good agent will send it to the title company. They'll send a copy of the executed contract to the buyer.
Yeah, and that's when
send a copy to the listing
absolutely.
agent.
And that's when I get started with the
And that's when you
piece.
start working your magic.
Yep, that's it.
Work your magic.
That's when we start to make the sausage, as they say.
Okay. And what are your recommendations if a property does not approve? Appraised and get appraised.
If it doesn't appraise, my recommendation: lower the price and let's move on. That's my recommendation, but that never happens. The listing agent wants to dispute it, or I got my second dispute approved in my 21 years last week. Second, right. Because they don't happen often. You're essentially asking the appraiser to admit that they got their job wrong, and many times they won't do that.
Right. One of the issues that I've found over the years is that by the time you get to the appraisal, the buyer has this mentality that, okay, this is the house I want, this is the house I'm going to get, and then the appraisal comes in and it comes in low. Mm-hmm. So it's a little bit of a kick in the pants for the client, for the buyer, then at that point they really are buying an asset that isn't worth that in the time. And so if they don't move in at that point, what they're really doing is buying on future value.
Right.
And sometimes the buyer will walk from it. I don't think it's necessarily the right strategy to take. I bought properties on future value. But if you really want to do it on a very disciplined approach, then you will try to get the seller, to drop the price. And I think it's important that the agent send that appraisal to the listing agent. We had an agent the other day that told us that the appraisal came in low. So we said to her, okay, send us a copy of the appraisal. Refused to send the copy of the appraisal in. So
it technically belongs to the borrower, so they don't have to send it. But if you're trying to really negotiate something, I mean,
but how do we know that the appraisal didn't come in high? The appraisal could have come in high.
Well, you would hope that no one would lie about it. I mean, it would be dumb for them to say it came in low, and because you're going to see it eventually. And
but we've had instances where we've represented the buyer. I'll be honest with you, we bought the appraisal, and we bought a property last year. It was a condo for one of our investors. I think we bought it for $125. It was appraised at $149. The other agent says, well, can you send me the appraisal? And we said, no.
It's not their business. It
really this is the contract price.
Right.
This is what we're paying for it. It needed some repairs.
That's it.
That's what my argument was, looking at it from the other side.
If you're disputing the price and you wanted to go lower, I think something from the lender to say, hey, it didn't appraise. This is where we came in at, would be sufficient, because it's their property. They don't have to show it to you. But I've seen it where they have given it to the other side, because ultimately we all want to get to the closing table. We just want to get to the closing table. We just want to get it done. So whatever we need to do that, if you're going to lower it, you got to show your seller, then let's do it.
It really is a kick in the pants, with some of these buyers, and then the appraisal comes in low, and it's happening all the time in this market at the moment.
It is
where we're getting agents that they're writing clauses in, basically saying, well, we'll pay $5,000 or $10,000 over the appraised price if it doesn't appraise.
Right.
We had one offer come in about 3 months ago where the buyer paid $70,000 cash.
Wow.
And at that point, you really start to drive the point home that we're talking about. You think to yourself, is it really worth it?
Yeah.
Is it worth paying that sort of money?
If it was $7,000 maybe, but $70,000, that's ridiculous.
Right. And some of these agents that turn around and say, "Oh, we'll just appeal." It just doesn't work that way.
Yeah, I agree.
It's very, very difficult to an appeal and appraisal. Jack, could you bring up that article, please? That I sent you, and we'll talk about that, and then we'll wrap up. Hi guys, this is an article that I found. Anything you want to go over, James? Or?
No. I was just going to say it's been a good talk. It's been really good talk today.
I found an article on Market Watch last night, which I thought was really interesting. How it was sort of it was talking about something that's important as we get into the end of COVID, and
kind of a snapshot of where we are right now, right? Yeah.
And it was basically saying surging U.S. housing market faces a test as people start heading back to the offices. And in general, what the article is discussing, that as people start to move back, from working at home and perhaps back to offices, what are the effects going to be? Because some people say there's a housing bubble out there. I will say that as a company, we're, downsizing, and we're going more to a virtual company with the technology that's available now. And I know that I spoke to some people in the commercial industry, and they've told me that a lot of businesses are downsizing, that they're going to smaller office spaces where they had 30,000 square foot previously. Now they're even going down to 5,000 square feet. More of their workspace is, just to save costs, basically, because they're finding out that they have got the systems. One of the big worries before was, well, people are working at home, they're going to, shirk off and go mow the yard rather than working. But one of the things that, can you scroll down a bit, Jack? One of the parts that's really interesting with this is, that's where it says the test is. Can you just go? The test is now, will those areas retain their values as we head forward? Will people's lives be flexible enough? The talk of potential froth comes at home prices climbed 13.5% in March from the year prior, the highest annual gain since December 2005, according to one gauge, underscoring the significant imbalance between U.S. housing supply and demand. Goldman Sachs analysts pegged home prices from Boise, Idaho, as 29% higher in April from the previous year, and up to 17% in Phoenix, while also forecasting baseline home price growth 6.8% in 2021 and 3.9% in 2022. So what do you think, James?
What stands out to me is they mentioned about it being the highest gain since December 2005. But we know the credit crunch, crash, whatever you call it, happened after that. So we were in a bubble seriously at that point because we were giving away money. We were giving away loans. You fog a mirror, we'd give you a loan. You didn't really, 100% financing, it was all the rave. Now it is much more difficult to qualify for a mortgage. You have to show that you can qualify for this mortgage.
And that's the qualified mortgage.
Qualified mortgage, right. There's guidelines that are in place now. You have to prove that you can qualify, the ability to repay this mortgage back. And I think that's the major difference in where we are now than where we were beforehand, because you have to qualify to get a mortgage. You can't just walk in it and fog a mirror and get a loan. So I think we'll be okay with it. Now, some areas may be a little bit more than others, because I think Austin's on fire right now with blowing up property values. But I think we'll be in a position to where we can kind of ride this a little bit longer and not be in any jeopardy of losing anything. So.
And how do you feel about future housing prices in 2021?
I think they'll level. I don't think we're going to see another double-digit gain like we have here recently. I think they'll level out.
Now more stabilized to sort of single-digit numbers,
go back
like
to our regular,
8% or 9% or something.
We'll go back to our regular appreciating values. That's what my thoughts are. Once all of everything kind of normalizes and people get back to work and such.
Right. I thought this was an interesting article because it gave some actual physical numbers on it.
Yeah. Market Watch, there's good stuff on there.
When do you feel that will flatten out to single-digit numbers?
Oh man, who knows? I think we'll kind of be in this where we are now throughout the end of this year, but maybe next year, second quarter or so, we may see some leveling out for the summer months starting.
For some reason, I don't think it's going to happen this year. I think 2022 it's going to happen.
I think it'll be in 22 for sure.
I really think because of the supply and demand issues that we've got in our area and also nationally, I really just feel that I can't still see it happening this year.
I don't think so either. I think it'll be probably second or third quarter next year.
And when we get to more normal lifestyle than what we've had with with COVID and everything else, I just feel that it's not going to happen this year.
Yeah. I don't disagree, sir.
I just think it will progress, but I do think that everybody needs to live the dream and everybody needs to do their best to go out there and buy a house. Nothing more gratifying from my own standpoint. When I came in as an Olympian and came in, as an immigrant, I bought a house, I think, within 12 months, 15 months.
Okay.
And it was the best decision of my life.
I think a good question that you guys should probably answer for somebody, let's say, because you guys are speculating that if it does crash, it's next year, right? So why would I buy a house now if I could just wait a year for the market to tank?
That's a good point.
Well,
that's a good point.
Not necessarily crashing, but I think it'll normalize. And here's the reason: because we still have the rest of this year left. So this year, if you buy a home, you can at least get it for the price that it is now, rather than the rest of the year is continuing to appreciate, because I think it'll continue to go up a bit. Then next year, it could be 30% higher than what you'll pay for it today. And who knows what interest rates will go, because I think once it normalizes, then I think the interest rates will push back up as well. So I think the benefit in acting now is, and you can get in on it, because builders are increasing their prices monthly at this point. So you don't want to get into a home situation to where what you thought you could get this year for $250, next year is $350.
Now, last time we had the crash, what did they do? They made it harder to qualify for a loan.
Correct.
So if there is a housing bubble burst, and it does happen, then aren't they going to make the loans harder to qualify for?
I don't think it's a bubble. The loans are already.
I don't think it's a bubble.
The loans are already hard enough to qualify for it.
I just think it's a lot of propaganda and hype.
It is. So I don't think it can get much more difficult to qualify for a loan now. And again, it's not that it's super hard. It's just more common sense. We never should have been given 100% financing to people that couldn't afford it. We should have had these. Well,
at one point they was giving loans 110%.
In some areas, absolutely. 125, I think, in California they were allowing that value. But yeah, we should have had these protections in place already, but they weren't. But now that we do, and we kind of know we've been through it, I think we'll be fine.
Right. Yeah. I read an article the other day where they were saying that more Americans now are saving. They're putting more money into stocks, and they're putting more money into housing than ever before, which is good for America.
It is. It is.
Which means that hopefully that emergency fund's going up from $600 in their bank account.
Exactly.
Exactly. To hopefully a little bit more and a bit more reserves. But so your prediction on the future is you don't feel it's going to burst?
I don't think there is a bubble to burst.
I don't either. So why do you think more millennials and X-Gens are not buying houses?
Well, some are in that mindset of they think that it's better to rent. Unfortunately, they don't want to fix anything. They don't have to take care of the extra responsibility of it, cutting grass and cleaning mildew off the side of a house or anything like HOA fees. Some of them just don't want to do that. They want to live in the city. They want to go downstairs and be right in the mix of the party area. You find some that haven't really grasped the true value of having real estate.
Well, and another problem that I think we have in the States at the moment, there's a lot of people that are going to college, are leaving college, finding it hard to get a job, and they get disillusioned with it. They end up moving with mom and dad.
Right.
And that in itself is, an issue. So people are also buying houses perhaps a little bit later.
They are. Yeah, they are. And some of them don't have an option other than to do that.
Right.
So, it's kind of one of those situations where they got to do it when they can.
It's unfortunate that's happening because, people are going to college. I'm a college dropout. I have no problem telling people that. I don't feel it ever hurt me. I just wanted to get out there and work, and try and do the right thing and make my life what it is and be responsible for my mistakes and my successes. But I do feel there's a lot of people that are going to college, but they're finding it hard to basically get their first job.
Yeah.
Then they're finding it longer. So it's taking them longer to get onto the housing ladder.
Well, going to college is not this golden ticket that they sold in the past. It takes several levels of it at this point, your master's or your doctorate, to even get to some income levels that'll do you well. And that's only depending on the field that you're going to be
right. And one of the things that I've always said is you can be the most educated person in the world. If you don't know how to apply that knowledge
Oh yeah,
to a particular situation, that knowledge is worth zero.
worth nothing.
You know, we teach that in the office because some people are up to date with contracts and everything else, but if you don't know how to apply the knowledge in a productive way to achieve your goal,
Yeah,
it's all worth it.
absolutely.
And
I agree.
as American society as a whole, I really feel that you know, we are letting some of the people down that have been to college and educated themselves, but I do think it's a myth. You go to college and that's what guarantees you a success.
Guarantees you nothing.
You know, even some corporations, I feel they make a huge mistake by getting people that, you know, in from college and you need a degree for this and you need a degree for that. Which really is better? Go and get street experience and become streetwise, working your way up, you know, through the business. Haven't you proved it more? You've got more loyalty to the company that way.
You're preaching to the choir. I totally agree with you.
Because that's honestly what I feel.
I agree with you.
I would rather have somebody, my father was a big believer in this, he was a small business owner, you know, you get somebody that starts from ground roots, even making the tea.
Right.
When I went to start his business, that's what I was doing. That was my first job, making the tea for all the workers.
Oh, literally making the tea.
Yeah, literally
Okay.
making the tea and basically working my way through the company to the point of where I knew that company. I understood the culture of the company.
Sure.
And that's what I feel is so wrong with some of corporate America. I have a corporate dislike for corporate America. So I think it's totally wrong. It's worse than corporate Europe. But I really do feel that's the mistake that they make. I think what needs to happen is a lot of these corporate companies need to have better programs to develop people, to give them that ladder.
Absolutely.
And then perhaps people would stay and be a bit more loyal
They
to that
would.
company.
They absolutely would.
And I really am strong feeling about this, that's what people should do. The companies should have a better development program, people to develop through the company, even the oil company.
Yeah,
All they do is grab people from, you know, college, not saying there's nothing wrong with that, but then...
Right. No, I agree with you. My grandfather, we just buried this past weekend, worked for a company for 70 years.
Wow.
70 years he worked, and they were at the funeral, that company. They were there giving tribute to him because he was there for so long. You don't see that anymore.
No.
You don't see it anymore. You know, he didn't go to college, but he worked. He worked and took care of his business, and he never complained and went to work every day.
Right.
I think we miss out on that a lot because we have kind of an entitlement attitude that if I do this, then I'll get this.
Right.
And that's not the case.
It's not.
Yeah.
Anyway, we'll wrap it up there. We've, as I said, welcome to everybody, you know, to the Olympian Table. We appreciate you taking a view at these videos. If there's anything that you want us to cover, please, leave it in the comments.
Absolutely.
As always, like, subscribe, and turn on notifications. We've also got the Olympian Table now in Spanish. You know, if you're a Spanish speaker, then hopefully you'll take a look at that. We'd like to hear your comments on that as well. But any subjects that you want me and James to discuss, we really would like and appreciate you leaving a comment. And, you know, let's hear your views. Let's hear your views on some of these issues that we've done. Let's hear about some of your experiences that you've had. You know, the good guys, the bad guys. Let's hear from you. So with that, we're going to wrap up. And from James Lee.
We appreciate you guys tuning in. And if you need us, our information is down in the description below. We look forward to talking to you next time.
You bet. And
All
so
right.
like, subscribe us, go on social media, and, you know, please add us as a friend and let's stay communicated. So with that, see you all next week, and thanks a bunch for tuning in.